I'd like to welcome you to the 2011 County of San Diego Economic Roundtable. My name is Ryan Ratcliffe. I'm a professor here of economics in the School of Business Administration, and I'm going to be the ringleader of today's festivities. I would like to introduce Chairman Bill Horn from the County Board of Supervisors, recently elected to a 5th term and has been serving since 1995 and is the current chairman of the County Board of Supervisors. He's going to start us off. So, Chairman Horn.
Well, thank you. Good morning and welcome. It's my pleasure to kick off the 27th Annual County San Diego Economic Roundtable. Over my 16 years, I've done this more than once. And I want to thank you for attending today's event. The Economic Roundtable continues to be the longest running free local economic forecast in the region and has grown to that tradition. For 27 years, we have kicked off each year with insight and analysis about the future of our local economy. And never, I believe, in my history here, has it been more important for us to know what's going to go on here. We've never had an economy like this since I've been in public office. The county and our partners are working together to bring together industry experts. I see Marnie here, economists and business leaders to inform you and to educate you. I saw a number of cities from North County out here that are represented. We have Don Stoyer, our CFO from the county, and he's not going to teach a class, but if you ever want to know, he's pretty good at it. And we search for opportunities in this struggling economy. We look forward to hearing your thoughts in our panelists, what the 2011 economy will hold for us, both nationally and regionally. We look forward to gaining additional insights in what is in store for the local real estate market and job growth. Having been a realtor for 32 years. I'm pretty close to that part of the economy. And from my forecast, and I won't argue with Marnie because he probably knows more about this than I do, but it seems to have leveled off. And I don't see it going back up, but I'm waiting for that good news. These topics especially are going to be timely for our residents, our businesses, and our nonprofit organizations and the government. At the County of San Diego, we take pride in our financial stability. We went through a huge crisis in 1995 where we almost declared bankruptcy following Orange County steps. We did not go there, and it was not an easy time. It was very difficult. But I think we learned some very, very prudent lessons that have helped the physical stability of the county and having us being watchdogs over the taxpayers' dollars. This disciplined approach has served us well and allowed us to keep essential services to the residents who rely on them. As you know, the headlines, the government is not immune to the recession. In this environment, the county will continue to do more with less, and it is our goal to monitor the actions of both the state of California and the federal government. This will ensure both fiscal stability for us and we want to maintain our stellar credit ratings. We're starting the year with a AAA bond rating, which we've enjoyed for a number of years. It is my goal as chairman at the end of the year to be able to stand there and say I still have my AAA bond rating. I know that's not very glamorous to the newspapers or anybody else, but it's what we pay for money, and that's an extremely important issue for us. I want to thank personally our partners in hosting this today. This is a beautiful setting here, and for their efforts to support the region and collectively move us forward in 2011. The San Diego County Workforce Partnership is one of our partners, San Diego Union Tribune, Qualcomm, and especially the University of San Diego School of Business Administration here. And this is prettier than the county. I was telling somebody earlier, we have a historical building. All we can do is paint it. We can't even fix the darn thing. So my goal was to tear it down and rebuild it twice the size, but CNSAL FDR put it in place in 1937. We are not allowed to do that. We get to paint it occasionally. I want to now take this time to introduce David Pike, the Dean of USD's School of Business Administration, and he has a few words for you. And thank you for coming, and make the economy better.
Good morning. Just to be clear, this is not the School of Business's building. It belongs to the School of Peace Studies, Institute of Peace and Justice. I have offered the dean there my building for this building many times. I've offered him Manny Ramirez and 2 future draft picks, and he won't do it. So we're still on the hunt. I'm the dean of the School of Business, and I get excited about a lot of things. I can either tell you a little bit of school, or I can ask you for money. So I guess I'll tell you a little about the school. We are really excited about what's happening. You saw outside, perhaps, Bloomberg Business Week has ranked our undergraduate program and our evening MBA program both in the top 30 in the nation. The Aspen Institute, which looks at social responsibility and ethics, has ranked our full-time MBA program in the top 25 in the world. And that's because we have great faculty who really are committed to the students and to student learning. In fact, a bunch of them here. Just raise your hand if you're one of our faculty members there. They're the ones responsible for those things. It's just fantastic. One of the things we've done recently over the last 6-8 months is look at our MBA curriculum from the ground up. We've looked at other schools, the best schools in the country. We've looked at what everybody's writing, and there's a lot criticizing MBA education and challenging us to do it better. More effectively, with more ethics and so on. And we gathered a group. We looked at employers. We interviewed a ton of employers and prospective employers. And we've completely revamped the curriculum. I'll give you just 2 seconds. We're going to start with an introductory strategy course that will set the table for all the functional areas and the disciplines that the students will get over the next 2 years. And then at certain points throughout those 2 years, they will get integrative experiences across courses and within courses and real-world consulting experiences that look at problems that companies have, that look at the triple bottom line, not only profits, but planet and people. And then at the end of their 2-year experience, they'll have an integrative strategy course that pulls it back together again. Because we live in a world, as you know, that's incredibly complex and global. When a volcano, whose name no one can pronounce as far as I can tell, goes off in Iceland, anyway, I can't pronounce it, and factories shut down in Frankfurt and Cleveland and all over the world, we live in a world that is very interconnected. You push down here and it pops up over there, and our students need to know that. They need to understand how that happens and why that happens, and to be on the hunt for when a volcano goes off somewhere, there's a tsunami or a blip in a supply chain somewhere in Asia, that they know that there are ripple effects in their business in Nashua, New Hampshire, or somewhere else. And so that's our goal, is to be constantly connected with the business community and understanding what the needs and issues are, so that our students are well prepared to serve you and that community. So we're really excited about what's happening in the School of Business, and invite you anytime. Come take a look at our historic building and join us. And now I'd like to introduce Jeff Light, the editor of the Union Tribune.
Thank you, Dean. I will say I spent, I guess, some of the longest hours of my life in business school. So to be able to be here just for a second to introduce the Roundtable is like really special for me. The Union Tribune is proud, once again, to be the sponsor of the longest running and I think most prestigious local economic forecast in San Diego. We're pleased that Dean Calbreth will help out in the question and answer session. Dean covers the economy for us. In 2006, he was part of the team that won the Pulitzer Prize for the investigation of the Randy Duke Cunningham scandal. I also saw in the audience Diana McCabe, who is our business editor, a good person to get to know if you get a chance, and probably somebody who would find some glamour in a AAA bond rating. So I'm not sure that was completely correct. Making sure that The business report and the understanding of the economy is strong, and the Union Tribune has been a priority for us over the last year. I'm sure some of you have noticed some changes. One that I particularly like is a panel of economists that Roger Sholey came up with last, I think, August. We have 7 people, some of them here today. You can find them discussing the issues of the day in the Sunday paper. And Roger launched it with this question in August: do you think the housing market will decline or rise by the year's end? So I went back and looked. The economists got it right. They, by 4-2, said that they thought it would be down by year's end. And then last week, the question was, do you think prices will rise in 2011? And this time we saw a little more optimism, because the economists said 5-3, they believe prices will rise by the year's end. So I thought that was encouraging, and I particularly like this question that was posed in November. Is there any good economic news, any good news? Sort of a low bar, but yes, 7-1, the economist said. So there was one holdout who I think is here today, so maybe we'll hear more about that. I'm looking forward to hearing more on the positive theme. To our panel of experts, as always, thank you in advance for lending us your much valued insights. And I, too, would like to thank the county, the San Diego Workforce Partnership, the University of San Diego School of Business Administration, and Qualcomm for co-sponsoring this event. And it is my pleasure to now turn it back over to our moderator, Ryan, Assistant Professor at the School of Business Administration. Ryan, thanks a lot. Thanks.
So just 1 or 2 more items of business before we get to the good stuff. We have 2 panels today. The first one we're going to start out with is the eye in the sky view, I guess I would say, from 3 of our prominent local economists, a little bit of national, a little bit of state, and a whole lot of local. After that first panel, we're going to have a brief time where I'm going to synthesize some of the questions that we've already received during registration and pose those to the panel, after which we'll take a little bit of break. And then we'll have our second panel, which is more the boots on the ground perspective from some local industry leaders. A couple other things to point out in terms of 2 things in your packet I would like to call your attention to. First is the pink sheet. That is your the method in which you can pose questions to anybody you see up here. In either panel. We're going to collect those pink sheets towards the end, and it's going to be my job to shuffle them all around and make sure that we get to zing the panel as often as possible with the questions that you're most interested in hearing the answer to. So please fill those out as questions occur to you. The other thing, there's a lot of stuff in that packet, but the other thing on your way out I'd like to point out to you is the yellow sheet, which is your evaluation form for, did you like the speakers and the organization and the coffee and Alan's tie and things like that. Anything about the event you'd like to tell us, that's your form for doing so. Last item of business is just a couple of VIPs I would like to recognize here. We have Catherine Field from Dianne Feinstein's office, Caridad Sanchez from Senator Barbara Boxer's office, Councilmember Gary Phalion from Oceanside, Councilmember Ed Gallo from Escondido, Councilmember Jerry Kern from Oceanside, and our very own Len Herring, former mayor of San Diego, at least as far as the Navy was concerned, and now USD's VP for Business Services Administration. So thank you all for attending. We're very glad to have you here. And with that, I'd like to introduce the first of our panelists, Dr. Lynn Reeser, Chief Economist for the Fermanian Business and Economic Institute at Point Loma Nazarene University. She has also previously served as the Chief Economist of the Investment Strategies Group at Bank of America and is a past president of the National Association for Business Economics. So, Lynn?
Thank you very much, Ryan, and good morning to all of you. I'm going to start our economic forecast by basically giving you the big picture in terms of the backdrop and the forces, both on the positive and possibly the negative side, that will be affecting San Diego's prospects during the next year. And let me focus basically on 4 topics. This is the Dean's suggested to you, it's now extremely important to understand what's happening in the global economy. Second, how much traction will we see from the U.S. economy? Third, financial markets. In fact, those AAA ratings do have a lot of glamour, so we'll talk about the outlook for interest rates and stock prices. And finally, fourth, how will California's economy fare in this environment? So first of all, in terms of the global economy, there is actually a considerable expansion that's going on in the world economy. Last year, we talked a lot about what shape this economy's recovery would be. Would it be V, O, U, the Nike whoosh? And if you look at the global economy, what's this kind of look like to you? More of a V, right? So we actually had a lot of economic activity taking place around the world. A couple of weeks ago, I was on a panel including the chief economist of FedEx. They had their single biggest shipping day on record before Christmas last year. How many packages do you think they shipped in one day? Any guesses? How many? 18 million. Any other guess? 50 million? The number right, you're good forecasters, the number right in between, about 30 million. 30 million packages in one day. So who was waiting for the last day of shipping? FedEx will do it. Now, in terms of the world economy, one very important theme that you should all realize is that we are today in a dual speed economy. Dual speed. The emerging markets growing at about 2 to 3 times the pace of the industrialized countries. These are countries, of course, China, India, other Asian countries, and in the Western Hemisphere, Latin America, countries such as Brazil. So we have half the world with very rapid growth fighting inflation, the rest of the world, Japan, Europe, the U.S., trying to revive growth and in some cases fight deflation. So very much a night and day situation. Now, as we look at the world economy in the coming year, I think there are a couple of issues to be watching. First, we've been up and down in terms of the whole sovereign debt issue that's been affecting parts of Europe, Greece, Spain, Italy, Ireland, Portugal, all needing now to bite the bullet in terms of restraining their deficit spending. It does, however, appear that Europe will do whatever it takes to preserve the euro's viability. The other topic to be watching very closely is what's happening in China. I was in China twice last year. They have a red-hot economy, and now they're trying to tame the tiger a little bit as they are trying to bring inflation down. They're very worried about rising food prices. Again, the question will be, can a so-called soft landing be achieved? My expectation at this point is that China will be able to succeed, but we'll still see pretty rapid growth this year, probably about 9%. Now, as we look at the U.S. economy, we just heard the final report card this morning on real GDP. You'll hear a lot about it in the news tonight. And we ended up on the year with a fairly strong footing. The last quarter's growth rate over 3% in real terms. Consumer spending rising very quickly, over 4%, and consumers really went out and bought cars. Durable goods spending up at an annualized rate of over 20%. So we had a pretty good ending of the year. Overall, we were growing about a little less than 3%, and this year I think we'll do even better, probably growth over 3.5%. So we do see the economy doing better nationally. Talk of a double-dip recession, I think, is pretty much off the platform. And if you look at what's happening in terms of our economy, we have actually now recovered all of the output lost in the recession, and we are moving to all-time highs in terms of output. It's a very different picture on the employment side, though, which is probably the more important barometer to most Americans. We are still down about 7 million workers from the high point at the end of 2007. Still, even there, we're starting to see some signs of improvement. Companies have seen some improvement in their sales. They're now more confident about sales prospects this year. Again, they're not worried about the double-dip recession. And they've stretched, in many cases, productivity gains about as far as they can be pushed. I mean, we can only work so hard during the day. And as a result, last year we created 1.1 million jobs in the U.S. economy. This year we'll probably create, in our estimation, about twice that number, about 2.25 million. Still, it will be likely until about 2015 before we actually bring the unemployment rate down to what we would call full employment, about 5.5%. As we look at inflation, clearly there again have been sort of two sides to the story. On the one side, we're all seeing rapid rises in commodity prices, food prices, energy costs. But on the other side, wage increases are still pretty subdued, and we also have those productivity gains. So overall, inflation in terms of consumer prices was 1.5% last year. We think we'll see prices maybe up around 2% this year, so still fairly subdued overall inflation. Now, as we look at the financial markets, will the bulls or the bears prevail? As we look at what's been really affecting all of us in terms of are we getting richer or poor, the two big question marks have been stock prices and home prices. Here you can see what's happened in the last 20 years, and you can see stock prices have been more volatile than home prices, but have also generally outperformed the cost and price of housing. Today, we're actually only 15% off the all-time highs of the stock market. So your 401k plans, which had dropped to 101k plans, probably up to at least 301k plans today. Meanwhile, home prices, though, are still off 30% or more from their high points, so twice as much down as the stock market. Now, the other big element that will be affecting the financial market outlook this year, of course, is the federal budget deficit. And this just seems to be getting larger and larger. This year it will be $1.5 trillion. And a trillion here, a trillion there. At some point, you're actually talking about some real money. This year, it will amount to nearly 10% of our gross domestic product. To benchmark that parameter, keep in mind that to join the euro, you're supposed to have a deficit GDP ratio of about 3%. So we would not be even qualified to join the euro at this point. Now, if you look at the Federal Reserve's policy, you probably have heard a lot about this quantitative easing, and this is a very important and actually historic move that the Federal Reserve made last fall. At that point, the economy was still in a lukewarm position. We weren't creating jobs. There were still concerns about a double-dip recession, and the Federal Reserve generally, as all of us, were not certain whether or not the tax cuts would be extended, and so the Federal Reserve made a very dramatic decision deciding to purchase up to $600 billion of Treasury bonds over the first half of 2010. That would take the Fed's balance sheet up to nearly $3 trillion by the middle of this year. There were about 4 channels that this was intended, or even perhaps not intended, to impact the economy. The first was to lower long-term interest rates to give the economy a boost. That lasted all of about 10 minutes. Interest rates went down briefly, but since they've moved higher again, mortgage rates today are approaching 5%. And this is in part because of the expected success of the Federal Reserve's efforts that more optimism about the economy has developed. Second, the Fed's move did push the dollar down. That antagonized some of our trading partners, but it certainly helped our exports. Third, as an unintended side effect, it drove commodity prices up, and that's had some negative effects on consumers and businesses. But probably the most important impact of the Fed's decision has been the effect on financial markets in driving investors to take more risk and particularly really giving the stock market a shot in the arm. Now, at some point, the Federal Reserve will have to exit this very easy money strategy. We don't expect to have zero interest rates forever. And in fact, by the end of this year or early next year, we could finally see the Federal Reserve nudging up short-term rates very, very slowly. But I think long-term interest rates will be rising more quickly as the economy improves. Some concerns about inflation, the large federal budget deficit, all are likely to drive long-term interest rates up. So long-term money probably up by about a percentage point from where we ended last year. Finally, as we look at California's economy does appear to be tracking fairly closely the national scene. Here you can see the year-on-year changes in job performance, and California is beginning to see some signs of an upswing. One big cloud in the future, though, will be the size of the budget deficit in Sacramento. With the overhang from last year and this year's shortfall, as you know, Governor Brown is dealing with a $25 billion shortfall. His plan is to address this about half with spending cuts, another half with tax increases to be voted on by the electorate in the summer of this year. But then you see that it's not just a one-time fix. This deficit is going to continue to be with us, even with an improving economy. We're talking about shortfalls of about $20 billion each year. And this will have an impact on local, the county, and the city governments, as there will be this pushback to the local level. As we look at the prospects for the state, though, kind of like to look at a balance sheet, and on the positive side, there are some significant pluses. We continue to be in this state a leader in technology and innovation. You see it in consumer electronics, you see it in the medical field, equipment, pharmaceuticals, and you see it on the business side in terms of systems, software, and hardware. As the esteemed head of our county supervisors has said, I think the experience in the real estate market is right on track. We do see the housing market in general starting to bottom out. I think we will see further signs of gains in exports as we see the benefits from this rapid growth in the emerging markets. And finally, tourism appears to be showing some signs of improvement. There still, though, are some significant red flags in our outlook. The budget pressures from the federal, state, local areas will all be the constraint on this side. In fact, last quarter, we did not have any support from the federal side of our economy. All of the growth we saw was from the private sector. Commercial real estate has not been the big drama that we saw on the housing side, but it still will be a tough year. You're going to see very few retail, office, or industrial buildings constructed. And finally, the last two factors, the K through 12 education system still is a very important constraint that needs to be addressed in the state, and businesses still are concerned about the high cost of regulation in the state of California. But overall, I think we'll see also better job growth in California in 2011. We created about 88,000 jobs last year. We think we'll create a nudge over 200,000 new positions in 2011. So to recap, as we look at the global scene, it will be an uneven platform, but I think generally the world economy is going to be expanding. The U.S. economy actually is gaining some momentum. In financial markets, I think we're probably looking for some increase in interest rates, but the stock market probably also will see some further increases. And finally, California's economy, I think, will also share in the national recovery. The bottom line for all of you and us here in this room is that I think the overall backdrop for San Diego is actually, despite some of the challenges, is fairly favorable for San Diego, and is considerably more favorable than it was just a year ago. Thank you very much.
Thank you, Lynn. Our next speaker is Dr. Alan Jin. I'm sort of surprised that I need to introduce him. I think this is the 27th Annual Economic Roundtable, and he's been here for 30 of them. If you don't know Alan, you must be new to the area, so I'll give you the brief rundown. Alan is my colleague in the economics department here in the School of Business Administration. A very lauded professor. He's won both the USD Parents Association Award of Excellence as well as Professor of the Year, nominated by the graduate business students. Perhaps in this context, he's best known for developing and publishing San Diego's Index of Leading Economic Indicators, a very often cited index of what's going on in the local economy now as well as what we can expect in the next 6 months. So it's my pleasure to introduce Dr. Alan Jin.
Thank you. I'm pleased to be able to address you again. I don't think for the 30th time, but it's been quite a few times here. As Ryan indicated, I'm best known for developing the USD Index of Leading Economic Indicators for San Diego County. And the last few years, we've taken the opportunity of this event to release our latest report, and we will do so again today. You have a copy of that report in your handout. Again, we just released it this morning. For those of you who are not familiar with it, our index of leading indicators designed to lead the local economy. By that, we mean it tends to move up months before the local economy moves up. It tends to move down months before the local economy moves down. So it gives you an idea of where the economy is headed then in the future. We have 6 components in the index that I will talk about individually, but for some reason or other, these components tend to move before the economy. For example, residential units authorized by building permits. When developers take out a permit at this point, that signals that there's going to be employment in construction months into the future. When those homes are sold, when the apartments are rented out, people typically buy furniture, appliances, they might do some remodeling. As a result, looking at the permits now give you an idea of economic activity months into the future. Our view is that the time frame involved is about 6 to 12 months, then into the future. So the latest report, the index behavior then looks something like this. We just had this terrible spell in terms of the index where it was down 24 months in a row. It had been down 35 out of 36 months. Then sometime in early 2009, it started turning, and it started rising, and it has been up or unchanged for the last 21 months. We had a spell there where it was flat for 3 consecutive months, but it has started rising again. And the report that we released this morning indicates that for December, the latest month for which we have data, the index has risen 0.4%. Again, that is a good situation that portends well for the local economy then in the short term. I'm going to talk about some of the individual components. You see that in terms of the components, 3 of the components were up, 3 of the components were down, but the positives outweighed the negatives. Let me start by taking a look at the first one here, residential units authorized by building permits, negative. As far as our index is concerned, when we calculate the trend in that variable by taking the seasonally adjusted moving average, we see that residential units authorized are down. And 2010 was not a good year as far as permits, resident units authorized by building permits are concerned. It was a better year than 2009, but still 2010 was the second worst year in terms of residential permits on record. We had roughly 3,300 residential units authorized by building permits. To give you some perspective, the biggest year of construction in San Diego history was 1986 in terms of permits. There were some months in 1986 where we had more than 3,300 permits. But still, a little bit of a rebound compared to 2009. We were up about 12%. So it was the second worst year ever compared to 2009. If you look at the breakdown as far as that's concerned, we had some strength in single-family units authorized. Single-family units were up about a quarter, up 24%. It was the multifamily where we had some problems. Multifamily down slightly, down about 7%. So construction, in terms of being measured by residential units, that's where that's the biggest problem as far as the index is concerned at this point. Now, in the index, we have two variables related to the labor market. We have initial claims for unemployment insurance. That measures the rate of job loss in the county. And the number, when we calculate the number, we invert it, which means that the negative that shows up there means that initial claims actually rose. So we had slightly more people applying for initial claims for unemployment insurance than in the previous months. Then on the other side of the labor market, we have help wanted advertising. That was down slightly as well. So for the first time since September of 2009, both of the labor market components were down. The positive thing about that, though, is they're not down by very much. You know, those are very small changes as far as any of the components then are concerned. The labor market has been tough here in San Diego. This chart here shows you what's happened to seasonally adjusted total employment since the year 2000. We're starting to edge up a little. You could barely see it at the end here, but if you draw a line from where we are now all the way back until you hit something, you see that that takes us all the way back to the end of the year 2000. We've lost about 10 years of job growth here in San Diego as a result of this downturn. We're at the same levels as we were at the end of the year 2000. So not a good situation. But if there is some positive, things are starting to turn. Okay, things are starting to turn. This shows you the unemployment rate. The unemployment rate. I compare San Diego County to the United States. You see that for a long time, San Diego was doing much better than the rest of the country. Sometime in 2007, we flipped so that the national unemployment rate became less than the local unemployment rate, and we've been there ever since. We've topped now 10% unemployment locally for 19 straight months. Now, that's the worst stretch that we've ever had in terms of the unemployment rate. If there's any good news, we're on the verge of breaking that string. The last report that came out for December showed that we were at 10.1%. I think if not in January, then in the coming months, we'll dip below that 10% mark. But as you see, we got a long way to go to get back to where we were in the middle part of the last decade, where we had unemployment at 4% or below. But again, the news was positive towards the end of the year. If you look at this chart shows you the employment changes in San Diego County. If you look at December of 2010 versus December of 2009, we were up. We had a gain of about 6,300 jobs over that period. And so, you know, that's the first time really since the early part of the year 2008 where we had positive year-over-year job growth. What are some of the biggest sectors in terms of movers? Well, on the negative side, you see that construction employment is still relatively weak, down about 2,000 jobs year-over-year there. Construction has just been devastated. At its peak, we had over 95,000 jobs in construction. We've lost about 40,000 of those jobs. So construction has been devastated. Manufacturing down as well here. Some damage in real estate. Government the fourth from the bottom there, also losing jobs. You know about the cutbacks in state and local governments. Federal government is positive here in San Diego, but that's largely due then to increases in employment in DoD, Department of Defense personnel. Leisure and hospitality flat after a couple of very tough years in terms of employment in leisure and hospitality. We're starting to see now more bars, though, moving to the right. So we're starting to see more positive year-over-year gains. You see that the sixth from the bottom is retail trade. Starting to see a little bit of growth in that area as consumers start spending a little bit more. Finance and insurance area up a little bit as well. An important sector in San Diego, professional, scientific, and technical services. That's where you have the lawyers, the architects, engineers. That's where you have the research and development sector in San Diego County, a little bit of growth there. But the biggest sectors where we had growth are those top two. You see that healthcare is second biggest growth. It's held up pretty well during this downturn. We've got an aging population. We've got an expanding healthcare system. That is going to be a growing sector for the foreseeable future. And then we had huge growth in the administrative support and waste services area. Those are the landscaping people. Those are the janitors. Those are the clerical staff. And that is also then employment in temporary agencies. There was a huge increase in employment in temporary agencies, about 4,100 jobs year over year, December to December. You could either take that as good news or bad news. It's good news if those people are being hired temporarily with the view that eventually they will be made into full-time employees once businesses are convinced that the economy is this recovery is solid. It's bad news if we've had a permanent shift where businesses are, delegating work to part-time employees without benefits as opposed to full-time employees. It remains to be seen where, in which of those two areas we are. Another thing that we have, another component of our index is local consumer confidence. We draw this from the San Diego Union Tribune. And this chart here shows you what's happened as far as local consumer confidence is concerned. The blue line there is the seasonally adjusted values as far as consumer confidence. Still kind of volatile, so I use a moving average, the red line, to smooth out the fluctuations. You see that we dropped precipitously from the high where the index was over 100, lost more than 60%. Of the value, rebounded sharply at the beginning of 2009, but we're kind of in a holding pattern at this point. Consumer confidence locally has flattened out, and so to me, this is an indication that consumers think that the worst is over, but they need more evidence, particularly on the job front, before they become really confident again. And this is significant because consumer activity is about 2/3 of economic activity. If people are worried about their jobs and their income prospects, they're not going to spend money, particularly on big ticket items like automobiles and homes. It affects, again, the retail sales situation. We have the cycle that's going on here where we've had this high unemployment that is leading to low consumer confidence, which in turn then leads to low consumer spending. And because consumers not spending, not buying, business is not hiring. And we get the cycle then going over and over again, reinforcing itself. During the downturn, this is reinforcing itself to the downside, and people were being laid off. This seems to have flattened out at this point. We need to get this moving then to the upside where people are spending money, businesses are hiring, and then we can get a reinforcing effect then to the upside. So my outlook for 2011 is that we're going to have positive growth in San Diego for the year 2011, but relatively weak by historic San Diego standards. Back when the economy was booming, we were adding 20, 25,000 jobs a year. During the real boom years, we were adding more than 40,000 a year. I'm anticipating job growth in the area of 10 to 15,000 for 2011. Okay, better than 3 years of job losses that we've had if you look at the average numbers, but still relatively weak by historic standards. That's enough, though, that's going to drive the unemployment rate into the 9% range, but it's still relatively high. 9%, unacceptable as far as San Diego is concerned. What are the areas that I think we're going to see some job growth? Again, healthcare, I think, will continue to be strong. I think the administrative and support services, again, will continue to be strong. Those were the two strongest areas in December. They will continue to be strong in 2011. I see a couple of areas that are going to rebound. Leisure and hospitality, as Lynn indicated, some rebound in terms of tourism, and I think San Diego will benefit from that as the national economy rebounds. And then I think there's going to be a rebound in construction as well. We've lost 40,000 jobs. If you're a cynic, you'd say that there's no more jobs in construction to lose in San Diego. We have no way to go but up. I think there is going to be a rebound, though, in terms of construction activity in San Diego. Some strength in the housing market. We're going to have a panelist address that in the second panel, but I'm one of the ones who predicted an increase for the year ahead in terms of housing. I'm expecting about a 5% increase in housing prices, putting the median from 333 to about 350,000 by the end of the year. Okay. Now note, though, that I was also one of the two that was mentioned who thought the housing prices were going to go up from August. So take this with that in mind here. Building permits, I expect to rebound to 5,000. Okay, that'd be about a 50% increase from their current level. So that's a huge percentage increase. But note that even if we had this rebound of 50%, this would be the third worst year on record after the last two. We've just down considerably then in that area. But again, I think some strength will bring some building back to San Diego. As Lynn indicated, interest rates are likely to rise, but again, by historic standards, still relatively low. I don't think enough to choke off the housing recovery. A couple of things to keep in mind, though, before we declare that we're completely out of the woods here. Federal, state, and local budget deficits are a potential drag on any sort of recovery. Usually when you have a deficit, you're going to raise taxes or you're going to cut back spending and employment, or both. And the deficit that we have at all levels of government could have a potential impact. You hear talk about, the state having problems, and one of the solutions they're talking about is pulling money out of redevelopment agencies, which would impact us here then in San Diego on the local level. I think the housing market, not completely out of the woods. I still think that foreclosures will remain at high levels, largely due to the huge amount of job loss that we've had. We've gotten rid of that first wave of people who had taken these subprime loans, but now we've got people who had good credit but are now, out of jobs. They've now lost their jobs. They've been unemployed for long periods of time, burned through their savings, and may end up losing their homes then as well. A potential problem is the sharp rise in gas prices. By my estimate, for every 10 cents that the price of a gallon of gasoline increases, that takes about $7 million a month out of the local economy. People would be spending that money on gasoline when they could be spending it on going out to eat or clothes or anything along those lines. So we've had a run-up recently. If that is sustained, that has the potential of taking some buying power, some significant buying power out of the economy. And then finally, the continued high unemployment is a problem. And it's at 9% here. A couple of things that could lead to some major structural changes in the economy. Just a large number now of long-term unemployed. As people now become unemployed approaching 2 years and more. They're losing their job skills. They become increasingly unemployable. This is a big problem, I think, that has to be dealt with not only locally but at the national level. And then this recession has impacted middle-class jobs particularly. And, that is what, in my view, fueled a lot of the economic growth in the U.S., people making middle-class wages with benefits, and they were able then to spend and help boost the economy. Support the housing market, send their kids to college, to USD here, and so on, okay? So generally positive news for the year ahead. Still not out of the woods. Like Lynn indicated, it's going to take us a few years to get out of this. We got into it really quickly. It's going to, unfortunately, though, take a long time to get out of this. Let me close by saying that if any of you would like to be on our mailing list to receive a notification about the USD index of leading economic indicators, I'd be happy to put you on our mailing list. Just contact me by email at the address on the back. We're doing notifications by email now, so I'm not spending the dean's money anymore with hard copy mailings. And again, I'd be happy to put you on our list. Thank you.
Thank you, Alan. The anchor of our economics relay team is Marnie Cox. He's the chief economist at SANDAG, the San Diego Association of Governments, which is basically the comprehensive planning organization for San Diego. Marnie's specialty is regional economics, and he works with a whole group of people over at SANDAG to produce the regional growth forecast, which is essentially kind of the baseline forecast of how many people we expect, how many jobs we expect, et cetera, and it's used by just about everybody here in San Diego as a baseline for planning things like how many buildings should we permit, what new infrastructure projects should we engage in, et cetera. So if you didn't like the traffic on the 5 on the way in here, this is the guy you should talk to, I guess. Thanks.
Good morning. Typically, you've heard from both state, national, and then also the local economy. So the question is, should I provide a competing forecast because we've heard all levels, or should I choose to talk about something else? So they've given me the leeway to talk about sort of the forecast in a different way. So what I've chosen here is a way to explain maybe where we are today, but I think some of the questions out there that you read about is how quickly are we going to be able to stabilize and get back to the level that we were before the recession started. And I think a lot of people are disappointed that the way that the growth is occurring nationwide as well as locally, it's not consistent with what's happened historically after deep recessions, where the economy has responded much faster and we've been able to put people back to work much quicker. So the question is, what's going on here? Why are things so different this time than they have been in the past? Well, while I was looking at this, I ran into a term, and I put this up here on my forecast, iatrophogenic. It comes out of the medical profession. And basically it means the medicine is the problem. So what the prescription that has been filled out is causing the problem with the patient. And so part of the question is what we have done so far, is that part of the problem? Is that why the economy hasn't responded? Is the prescription we've filled out, the results of that have made the patient worse? So I want to bring that. I don't have a solution to that, right? That's part of the argument that's going on today at sort of the national and local level. What is it that we're supposed to do if we would like to get things rolling again faster than they are today? Should we turn to government and ask them to stimulate the economy in various ways? Or should we allow the private sector to do it, but in order to do it, they need greater leeway, right, in order to get started again? And I think that debate is ongoing. And as the forecasts show, things will turn around, and I agree with both Alan and Lynn's forecast about the growth. Question is how quick that will be. Because imagine this, you have elected officials, and they run for office based upon promises they make. I can't imagine an elected official running for office saying, be patient, the unemployment rate in 5 years from today will actually be back where it was before the recession started. I think that's how good we'll be. I can't imagine that. So having been in the public sector a long time now, politicians don't have patience. They want things to change quickly. And so you're likely to see more policies coming down. And what those policies may be is a good question. Which side of the fence they fall on is a good question. And how they impact the patient. So let's start with a little bit of background, take a look at jobs at the national level. And first of all, this shows on a year-over-year basis by month how bad jobs fell. As Lynn pointed out, we lost about 8.2 million jobs nationally. On a year-over-year basis, the trough was somewhere around 7 million jobs at the national level. Some growth has started at the national level. You can see by a year-over-year basis. And then the second thing to note is that San Diego is just about 1% of the nation. And so at our trough, right, if we were equal in our proportional share of job losses, we should have been down about 70,000 jobs. So if we lost 7 million on a year-over-year basis, we'd be down about 70,000 jobs. Well, we were down about 103,000 jobs at the trough. So our impact here locally was probably greater than what the nation experienced overall. Now, the next thing to look at is how well are we doing in terms of coming out of this recession? And so here, this chart indexes once the recession ended, and it ended in June or July of 2009 most recently. And it compares that against 3 other occurrences. We take a look at all the recessions dating back to the end of World War II, all 11 of them. And we find the best one, the worst one, and then the average. And I'll concentrate just on the average. The average here is the blue line, and it shows today, about 18 months after the recession had ended, our employment growth should be up about 6% or so, but instead we're less than 1%. So we're clearly way below where we should be just on an average basis. Still not the worst. There was a recession that was actually worse than this one. Now, part of the question is what's going on with the slow growth? Now, these charts I shared with the group last time, but I thought at that point we had only spent about 30% of the stimulus fund. And so I was projecting that the stimulus fund wouldn't have the impact that they were suggesting it would have by holding the unemployment rate down below 8% and the economy picking back up. And so I thought I'd bring them back up. Only now that most of the stimulus money has been spent, now we can look back at where it was spent to determine whether or not it was spent in the places that would impact job growth. And so I start out by saying, let's take a look at what most people understand as employment multipliers. And that is, for a dollar spent, how many jobs are actually created for that dollar. And you can break this down into 3 areas. You can spend a dollar and get a 0 impact. And you can do that by the government deciding to do something in the private sector that it was once doing, or the government takes over what the private sector was doing. So no impact, right? 0. No job growth. The other way to look at it is exactly 1, where the dollar we spend utilizes existing unused resources, but it costs us just as much to put those resources to work as it does to use them. So we got 0 impact. The greater than 1 represents the concept where you actually spend money, the expenditure of that money creates earnings, and then the earnings allow you to hire additional people and put additional resources to work. So you got to have earnings in order to do that. So with that as a background, what I did is I went through and I organized the $787 billion stimulus program into 3 categories, taking a look at what those categories' impact would be for job growth. And basically less than 10% of the money that we spent was actually in a category to actually create jobs, has a multiplier of greater than 1. The other, more than 90%, was spent in areas that had 0 or 1. And so, looking back, right, where we had spent only 30%, and they had all these plans about how to spend the money, if you put them into these categories, you say, wait a minute, if you really want to bring job growth up and the unemployment rate down, you probably want to pick different categories, right, because they're not going to have the same impact in terms of job growth. Then the second thing that happened, I think this is just as important, is that we seem to have changed the way that we treat businesses, right? There's this concept that if you don't do a good job as a business, right, and you go bankrupt, you should go out of business, right? You should turn those resources over to somebody who can utilize those resources better. That was caught in terms of this creative destruction, right? That's the Schumpeter term for that whole concept. The idea that capital, money, and resources, if you don't use them correctly, somebody's going to come along and say, I can do a better job with that. And so they take those resources away, grind them up, and produce something new that consumers want. Because actually it's the consumer that determines whether or not whatever is produced, services or goods, are actually purchased, right? But instead, we seem to have changed our methodology, where we today want to protect businesses. And so if you look where a lot of the American Recovery and Reinvestment Act money went to, a lot of it went to a lot of businesses to prop them up, most notably the car companies, but a lot of banks, things like that. A ton of businesses you can look at. The list of them is very, very long in terms of who got money from the federal government. But that's sort of the, you know, whether you're big or small, you're sort of protected from failing. And so those resources then are protected. So you've drawn a wedge between this creative destruction part. And I think in part, again, does that impact the way that our economy has reacted and the job growth that we've seen, or lack thereof? Well, there's been some recent reports that have come out, most notably from the Kauffman Foundation, that shows that between 1980 and 2005, that about all of the job growth, with the exception of 2 years, were created by firms that are less than 5 years old. So it's not just small business that creates the jobs, but instead it's firms that are less than 5 years old. Back to the creative construction concept, right? New firms are created, the CEO or whoever's managing the firm says, look, I got this idea in mind, we're going to have to hire some people in order to get that done. You think about a firm that's, say, 10 or 15 people, but they're 25 years old. They have an entirely different philosophy of how to produce goods and services. They're not looking to grow 30% per year, right? But the guy who just started his business and has in mind taking away somebody else's market share has a different philosophy. And so business generation and startups, right? Not all of them succeed, but that's where the job generation comes from, is there. And so if we drive a wedge between creative destruction, then we're not going to get job growth at the other side of that. And so again, back to this point where iotrophogenic policies may be responsible for the slow employment growth that we're seeing. Now, the second area that I want to concentrate on besides job is consumption. And the reason for that is that the newspaper now attributes somewhere between 70 to 80% of GDP to consumption. If you read about it in the newspaper, unless the consumer starts spending again, the economy is going to continue to drag, because 70 to 80% of GDP comes from consumption. I would argue that that's an accounting routine, not an economic routine, but I'll leave that go. But here, this gives you an idea about what happened to consumption on a monthly basis. First of all, we started out somewhere between the $400 to $500 billion level per month in consumption expenditures. We lost during the recession, but when it came back up, now we're between $300 to $400 billion. We haven't risen back up to the $400 to $500 billion consumption level. And so consumers haven't come back the same way that they went into this recession. Let's take a look at that in terms of past recessions, where we are. Same tool we used last time. And you can see typically that we're 15, 16 quarters into this end of the recession, 5 to 8 quarters into the end of the recession. By this time, we should be about 7%, right, on average. If you look at all recessions, consumption should be up by about 7%. Instead, we're about 2.5% up, right? So this is much slower. So what's going on? Well, there's two things that are going on that I think impact these types of trends. First of all, consumers are feeling vulnerable because of the type of recession that we went through. Asset devaluation, where wealth, we actually lost a lot of wealth, both in terms of stock as well as housing equity. And so households started paying off debt as opposed to continuing to accumulate it. So if you pay off debt, you're not spending your money, right? You're paying it off. If you were spending money in the past, both from your income as well as out of your wealth, taking home equity accounts, things like that, and spending it. That allowed us to get our expenditure or consumption to disposable personal income ratio up to about 140%. So that's unsustainable in the long run. Our disposable personal income should be a guide to how much you can spend. 100%, right? Then you're done. But instead, we were spending close to 142%. That's not sustainable. We were consuming way more than what we were earning. So now we're beginning to pay it off. So the second thing that's going on is while we're paying that off and feeling vulnerable, consumers are now increasing their savings. And so savings went from about a 1% up to about 6%. And for every 1% increase in the savings rate, you lose about $100 billion out of expenditures. So that's about $500 billion we lost, right? Because people are saving more as opposed to spending it. That's probably part of the reason why consumption hasn't come back up again. But are paying down debt and a rise in the savings rate bad? What you would think that they might be, because the policies we put in place are all about stimulating our expenditures, right? Even though individually, right, especially if you're have so much debt outstanding yourself, you can personalize this a little bit. You know, if you're paying down that debt and raising your savings rate, you're feeling less vulnerable. You have more resources you can fall back on during turbulent times that we're in. But you don't get that feeling that that's the way that they would like things to happen. When I say they, government policies. Again, iatrophogenic. Now, the last thing I want to point out here at the national level is something Lynn has alluded to in hers. And there are a couple policies that took place. The question is how important or what impacts those policies had. The first one on the left over there represents the balance sheet of the Federal Reserve. And it has two things, sort of money in circulation, that's about $800 billion or so. But on top of that, in that spike line that goes way up, that's where they said to the banks, look, we know you guys have bad assets on your accounts, mortgage-backed securities. We're going to take those off of your account. We're going to give you back cash for them. They're probably not worth the amount of money we're giving it to you, but we're going to give you that cash because we know your balance sheets, your liabilities are greater than your assets, so you're literally bankrupt. So to stabilize the banking system out there, that's what we're going to do. We're going to exchange assets on your account for cash on hand. But what they also expected to happen was that those banks would then turn around and lend that money out. And that's what didn't happen, because the loan of the money out is actually what stimulates the economy, right? People see an opportunity, they borrow money, proceed on that opportunity to bring a service or a product to fruition that consumers can buy. But if banks aren't lending, then that can't occur. And that's what's on the right side over there. Consumption has yet to come back up above the line. We're still below where we were before the recession restarted, despite over $1 trillion being on the books of the banks that is available for lending, right? Their standards are so high today that they're not making those loans. And so now we've sort of cut that cord between what the Federal Reserve would like to occur, I'm going to give you money, lend it out, and the bank's willingness to do that, right? They just didn't act the same way they had in the past. Maybe they see something. Maybe they're feeling vulnerable. Whatever that issue is that they haven't acted the way that they thought they would. Now, turning to the San Diego economy here, I want to make a couple points. One, if we take a look at this recession and we take a look at past recessions, this one was significant. I went back to the 1990s, and that was the worst recession we had, was sort of defense-led, real estate sector-led kind of a decline we had. But in terms of jobs lost, we lost in the worst quarter about 20,000 jobs in that last recession. This one, we were down in worst quarter over 80,000 jobs. That's a significant difference between recessions. The length of this recession is about 10 quarters long. We saw at the end of 2010 our first increase, quarter numbers year over year, increase in jobs. And so after 10 quarters of continuous declines, we finally see a positive rate of growth in employment. However, And the importance of where those jobs are is important, and I'll share why in just a minute. On the left side over there is after the 1990s recession ended. We take a look at the distribution of job growth. And we can see here that professional services and government, wholesale retail trade, health services, and information were the major contributors to employment growth after that recession. And then you look on the right side and where we are today, and by 6,000, well, I don't know whether or not we'll have 6,000 job growth during 2010 because we still need to go through an adjustment that the EDD does each year to yearly employment numbers. But I'm expecting it's about 6,000 jobs. But there's a ton of concentration in just 2 or 3 areas. The professional services area, about half of that is temporary service jobs. And then you go down in health and education and then the leisure. And that's it. Not a very broad-based recovery at all. And also what happened in the end of the 1990s was this huge growth in what we call emerging growth technology companies, right? And so San Diego came off a defense sector downturn and it diversified out into a wide range of emerging growth technology companies. And so we got this broad base of support for employment growth. This time it is narrow-based and selective to single industries that probably are not the same kind of industries that will have the same kind of impact on the long-term growth for San Diego. And what I mean by that, you can take a look at real per capita income, which is a measure of standard of living. This takes us back over 30 years, and actually most of the growth, over 90% of our real per capita income growth occurred at 2 points in time, about 5 years each, so 10 years out of the entire 30. One was back in the early 1980s, and that's when the Reagan administration took office, doubled the Department of Defense budget, and locally it tripled. Went to over $9 billion from $3 billion. We added a lot of defense-related jobs, very high-paying, high-skilled jobs, and sure enough, real per capita income shot up. Cold War ended, we lost a lot of those gains. We lost a lot of those jobs, so real per capita income started to go back down again. Then along comes the emerging growth technology companies, and for about 5 years, from 95 to 2000, this is where a majority of our real income per capita growth occurred, right there in that time period. Plus, we really didn't lose it. Even though it tailed off and didn't continue to go up like a rocket, we didn't lose it. The last little growth rate there is not so much job growth. Remember I said real per capita income. It has to do with containing inflation. Inflation was real low, so our real incomes rose up. Not so much a type of job growth as much as it is containing inflation. Then the last 2 years here, what we've seen are declines. We've lost about 2% in real per capita income for each of the last 2 years, so we're down about 4%. Those are really difficult to get back without the type of job growth that adds wealth to the region. It will be difficult to make up ground here with the type of jobs that I just showed you that we're growing in the economy today. Very difficult. And then the last slide I have here is to take a look at population growth. And as Ryan mentioned, population is probably one of the most important things to a group like the San Diego Association of Governments. We do long-run infrastructure planning, so we need to know about how many people will be in the region 30 to 50 years from today, so we can build freeways and we can build trolley lines and bus lines and other kinds for transportation, so we can tell the county water authority where their services might be, how much water the region might need, so we can share that information with SDG&E about power demands that the region might have. So we're really into long-range forecasting that way. But I wanted to share with you what's a trend that has changed here locally. And I want to draw your attention to a couple things. First, that green line is called domestic migration. It means the difference between people moving in and out of the region. And since about 1990, there's really been no growth in domestic migration. That we've lost as many as we've gained. So the net is about zero. That green line that falls below the line there means more people moved out than moved in. If it goes above the line, it means more people moved in than out. But it basically nets out, right? So we've had no growth from domestic migration. And domestic means people living from other places in the United States moving to San Diego to take advantage of whatever opportunities are here. But historically, That was one of the primary contributors to our growth. And that's that green line as you move beyond 1990 back into the 1970s. So we're no longer growing from net domestic migration, but instead it's coming from two other areas. One, net natural increase, right? More births than deaths. And that's the major contributor. About 2/3 of the growth today comes from that. But that has a much different impact on your economy, right? Net natural increase, more people being born than dying. That's not the same thing as generating new housing units, right? New jobs required to take those positions. Much different impact on your economy, more of a long-run concept. The other part of the growth comes from that red line, which is foreign immigration. So right now we're growing because of two things: net natural increase and foreign immigration, and the domestic migration is literally zero. So those are big sort of changes that have taken place that we incorporate in our long-range forecasting. And also, if you think about it, this kind of growth has a different impact, different demands on your economy altogether. So sometimes history, right, it's not a good guide for what may happen in the future when trends like this have changed. And I think that refers back to the iatrophogenic concept that I'm making. History may not be a good guide, right? The type of policies that we have in place today may not be a good guide, right, for what actually ails us. Now, in terms of summary, I want to point out two things. At the top, the 3% GDP, 3 to 3.5% GDP, is that sufficient, right, to put everybody back to work? Well, we need about somewhere between 100 and 150,000 jobs per month nationally just to take care of the growing labor force. And then on top of that, if you can grow higher, right, then you can put people who are unemployed back to work. Right? Now, it doesn't mean that's the priority, but that's basically the arithmetic, right? I don't know who's going to get the job, whether it's the new person or the existing unemployed, but that's the arithmetic. 3%, 3 to 3.5% is not enough growth in the economy to put those people back to work for 5 to 8 years. It's a long time. Again, I get back to that point, were we going to be satisfied with that, right? As you elect people on different promises that they'll carry out, we'll be satisfied with that. And that's what the forecast is, right? People are not forecasting 4, 5, 6%, which would put people back to work quickly. That's not what we're forecasting. We're forecasting the opposite. So that means that they don't see the policies that we're going to put in place today having the impact necessary to create the job growth to put those unemployed people back to work. We're at all-time high today for people who have been out of jobs. About half of them, people who are unemployed, I think the median is about 28 weeks or so. That's a long time. Pretty soon you lose your skills. Your ability to get back into the workforce is tempered with, right? The ability to actually integrate back in becomes troubled. So this sets up, if it is long-term, there are other issues that will arise because of that we're not full taking account of. And then the risk to the forecast is down at the bottom. And that is, again, what's on the table today are programs that would increase the debt, right? We're taking 2% off the payroll tax, right, to stimulate the economy. But the payroll tax is what pays for Social Security. Social Security is already in trouble. So we're exchanging expenditures here, future for today. Question is what we're spending them in gets us back earnings so we can pay back what we're borrowing and still have money left over. If we don't do it that way, then our exchange is not a good one. All we've done is created more problems in the future for less problems today. We have to have earnings. The economy has to grow in order to make up for that difference. And it doesn't appear that some of the stuff on the table today will actually accomplish that goal. So I'm questioning that. The last thing is sort of this interest rate and inflation issue. A lot of people have been expecting, because of the growth in the money supply and also the excess reserves, why hasn't inflation rocketed off? And I think the answer to that is that the excess capacity in the market today, meaning unemployed people and unemployed machines and other things that you use, is greater, right? That excess capacity is greater than the influence of the money. There's not too much money chasing too few goods, which has shoved up inflation, but instead there's too much capacity. Where you are beginning to see inflation creep up is what was mentioned by Lynn, and the growth rates that are going on in some of the developing countries, the BRICS, Brazil and China, India, places like that. Those is where you're seeing inflation beginning to arise. And some of that's due to our currency policies that we have in the United States is creating inflation over there. So we're probably going to have to deal with that in the future. But I'm sure I've run out of time by now. But thank you very much.
Okay, so in the last little bit here before we take our break, I want to basically synthesize. You had the opportunity to ask some questions of our panel as you registered. I would say over 60% of those probably had to do with the job market in one sense or another, rightfully so. That's kind of what's on everybody's mind here. A couple other questions about the state and federal sort of budget situation that I think I'm going to defer for our second round of questions. But I think also I want to ask a couple of job-related questions just sort of quickly of each of our panel before we go to the break. So Lynn, I'd like to start with you. One of the things I think kind of came out of everybody's presentation was that there's just something about this recession that seems fundamentally different from kind of the typical recession we're used to thinking of in kind of the post-World War II era. You know, for instance, Marnie was talking about how the median duration of unemployment is so much higher this time relative to what we've seen before. So just generally, I'd like to kind of hear your thoughts on why is this recession so much different? And then I think specifically to the job market, you know, one of the kind of debates that's going on among macroeconomists as to what extent the unemployment we're seeing is just cyclical, this is a really bad recession, so we're having really bad unemployment, versus a more structural shift in the economy that a lot of these jobs just may not be coming back.
Two issues. First, this recovery has been different than most recoveries. As Marnie was suggesting, you saw it's been a significant recovery, but not nearly as strong as you would expect given the steepness of the downturn. And this actually has a lot of historical precedent. If you look around the world, a lot of studies have been done on this. And the fact is that when downturns are caused by major financial crises, the upswing is often much slower than normal with more lackluster job performance than typical. So the causes of the recession, because it was driven by this financial meltdown, has impacted the character of the recovery. Now, as I pointed out, though, still we recovered all of the lost output, but we still have this huge job shortfall. And there are some puzzles going on. If you actually look at the number of job openings, that has increased even while the unemployment rate has remained high, and there are today 6.5 million Americans who have been out of work 6 months or longer. So why aren't they taking these job openings? And I think a couple of things. One, the fact that there are significant unemployment insurance benefits. You can have those now for nearly 2 years, has meant that many job seekers are not willing to take the first job at McDonald's. They're not willing to take a big cut in their salaries. They're still hopeful that they can find that job that will pay them with their skills that they would like to see. And also, I think there's a mismatch between some of the jobs that are available, where companies are still looking for qualified engineers. For instance, the oil sector looking in Texas, Oklahoma for a lot of engineers, other technical skills, and the skills are just not there. And then third, there's also a problem in terms driven by the housing market, where there might be jobs available in Oklahoma or Texas, but if you have a house in San Diego or you have a house in North Carolina or New York, you may not be able to sell that home and move easily. So all those factors are at work. And finally, the fact that companies have learned to be smarter, work with fewer people, has also made this job recovery slower than normal. But I would end with, I think this job market in 2011 is going to be significantly better than it was in 2010. This will no longer be perceived as a jobless recovery.
So a similar spin on the question, but from San Diego's perspective now. So first, I'd like to get your thoughts, Alan, but Marnie, I'm also going to ask pretty much the same question of you. Alan, you showed a graph where we basically have the same level of total non-farm payroll employment in San Diego County that we did back in 2001. We talked a little bit, both you and Marnie did, about how defense was really the engine of growth in San Diego in the 90s. In the kind of post 2001 recession recovery, a lot of San Diego's growth was housing and finance related, kind of the finance that goes along with housing. What do you see as kind of the engine of growth in San Diego? Not just looking at we know it's temp jobs and healthcare and a little bit of tourism right now, but more what's going to be as we're kind of shaking off the hangover and moving into the next phase of growth in San Diego, what sectors are going to be the engine both of job growth, but also kind of to Marnie's point of income growth as well?
Well, local economic development officials are targeting 4 areas in terms of trying to attract and retain jobs in San Diego County. They are, number one, the defense security area to sort of leverage off of our military and space war and efforts along those lines. Number 2 would fall in the category of telecommunications / software, again, to build on the telecommunications industry here, Qualcomm and so on. Number 3 would be the biotech healthcare sector. We saw that healthcare was growing, but also we have this huge research sector in terms of biotech. And then finally, the 4th sector that they're targeting is green tech. It's becoming an increasing part of the overall economy. And again, those are sort of the cutting edge types of job categories, things that have the potential to bring big income into the area. Whether or not it's successful, whether or not there are enough jobs in those areas to drive the economy is a question at this point. But again, those are some of the areas that are being targeted.
Okay, so Marnie, just one more little spin on it, but basically the same question. You know, a lot of the list of sectors Alan was mentioning are all high tech, high skill kind of things, and I think you look at some of the recent census data about San Diego, and one of the things that is good news is we have a significantly above average share of the population with a bachelor's degree or better. At the same time, we also have one of the highest shares of the population with less than a high school degree. So, you know, so first your thoughts on kind of the engines of growth, and second, you know, do we have a problem maybe of a skills mismatch?
I think first I'd address the question a little bit differently. I first ask myself that if businesses are going to hire, what is it that the consumers are buying in order to add the people to the workforce necessary to support the job? And so I think as a first question here, then you have to ask, well, what kind of an impact do you want to have on your economy? And I guess maybe there's 2 answers to this. One is, if you have high unemployment rates, right, what kind of services or products will consumers buy that will put a lot of people back to work very quickly? Right? Now that's a different question than, can we get real per capita income to grow? Right? That's a different question. We're putting people back to work quickly. And actually the answer for that is more service-related jobs. And the visitor industry is a good example of that. If there's $1 million of expenditures in the visitor industry today, that supports about 45 jobs. So if you want to put people back to work quickly, there are certain types of industries that are more labor intensive than others. The manufacturing side, take Solar Turbines, for example. If they sell $1 million worth of product, they only need 15 people. Right? So part of your question is, am I trying to put people back to work, lower the unemployment rate? Or secondly, am I trying to raise real per capita income or wages? Because solar, right, requires skill, education, training, and pays much higher wages, but they require fewer people. So again, I get back to the point about which problem are we trying to solve here. And I think the solving of the problem, the unemployment rate is near term. We need to do something about it quickly. So we need to turn to those industries that put people back to work quickly for small amounts of expenditure or sales. And in the long run, we need to build infrastructure in order to support a more high value added job growth than what we have today. Because as I said earlier, the real per capita income, which is sort of our wealth and standard of living in the region, what you invest in will determine your long range growth. So the more we build of an infrastructure that supports low-paying jobs, lower than the average, the more of those jobs we'll get. All right, so we got a quandary here. Right? I'm asking for sales today in the visitor industry that put the unemployed back to work, maybe not the construction of new infrastructure to do that, because then you put in motion a long-range need for even more workers. But instead, start to think about capital investments in different types of industries, and Dr. Jen mentioned them already, the biotechnology industries, the wireless, the software industries, groups like that we have good footholds in. We're competitive in nature, but that would then set in motion the infrastructure necessary for us to create those jobs in the long run.
Okay. Alan, you wanted to add something?
Yeah, you mentioned the education system or how education would impact this. Before this Great Recession, we were headed into a sort of a bifurcated economy anyway, where we have, the digital divide causing, people with real high educations to do really well, and people who don't have the skills not to do well. And I think this Great Recession has exacerbated that situation. A lot of the job loss basically hollowed out, in my view, the economy, wiped out a lot of these jobs that used to be held by people who had relatively low education and skills, but still were able to find, pretty good paying jobs. A lot of those are gone and are not coming back. So I see a greater divide as far as the economy is concerned. And then on top of that, it's going to be compounded by cutbacks that we're seeing in education, particularly higher education at the state of California level.
Just to bring some numbers to that point that Alan's making, the unemployment rate today for people who have a bachelor's degree or higher is a little less than 5%. For people who do not even have a high school diploma, that rate is 3 times as high, close to 15%. So we've lost jobs across the board, but everyone suffered in the recession. But clearly, education is a big roadblock.
Okay, so let's get started on our second session. We're very fortunate here to be able to complement the perspective of our economics team with the view of 3 local experts who very much have the perspective of what's going on the ground to provide some context and some extra insight that lies between the statistics. Our first guest is Mark Marquez. He's the Vice President of Weichert Realtors, has 12 years of experience in the real estate industry, is the outgoing president of the San Diego Association of Realtors, is a director of the California Association of Realtors, kind of the local expertise for the state organization, is involved. If there was an International Association of Realtors, he would probably be on their board as well. So I'm very happy to welcome Mark Marquez to give us some insight on the local housing market.
Hi, I'll try to make this as relevant as I can to you folks. I know you're inundated with a lot of statistics, so what I'll do is we'll present several slides showing you the more relevant statistics within the housing industry. And then I hope to address some of the intangibles that you probably don't see or probably won't read about, but they're actually happening in our market here locally. The San Diego Association of Realtors, if you don't know, exists. It's a trade organization composed of our realtors at the local, state, and national level. We're approximately 11,000 members strong. We're here to protect private property rights. Not only for our realtor members, obviously, but for the common good in the public. So we're big advocates also politically, so we take our political action very, very strong. So we're out there on the ground defending issues that would inhibit our right to transact property as well. So we have a huge government advocacy department as well that's very, very important to us locally. There's good news and bad news when we look at 2010 and 2011, or in what we're projecting for 2011. But in 2010, we saw decreases in sold listings versus 2009. You can see the figures in front of you. It's only off by about just over 1,000, 1,400 units, plus or minus whatever the math is, but down about 7.3% on the detached and attached, or a 4% decrease. The good news is even though we saw a decline in sold listings by property type, the one thing that is an interesting phenomenon for here in San Diego is our median price continues to hold. And so, your economics instructor can give you the definition of median price, but median price is for 2010 is 385, and for 2009 was 352. And even though you continue to hear mild or bad news occasionally in the news right now, you'll note that our median is holding. That, to me, as a professional and as a broker in this town, is far more critical to me than just the fact that we're off in units. So there's how it looks as we look at from December 09 into the tail end of November there. So that being said, we see that as a first sign of recovery. And I'll tell you, and you really have to look at our market in terms of segments. What I didn't bring is a slide that shows you the different segments, but for instance, you have an entry-level segment in our town, which I would define as under $400,000. You have a mid-price point of approximately over 400 to under $1 million. And then when you get over to $1 million, it changes much more, it's a different profile. And the reason that becomes more significant, because when you're talking financing, FHA loan limits cap out at $697,500. So when you're looking at price points in our town here in San Diego, we have a lot of homes in that near $1 million price range and over $1 million price range. And so we obviously want to see the median climb, but we also want to be able to look at the market in its relevant niches. And we have a very healthy base at the entry level. The bad news is, because we have a healthy base at the entry level, it's not folks that are, those entry level sellers are typically in distress, are what's called a short sale transaction, a foreclosure. And so they are forced into the rental markets and are creating a lot of leg up transactions. So whereas the first time military home folks buying their first house, they might buy that first condo, the guy with the condo is coming out of the market and going into a rental because they're in distress, versus going and buying the next house that's maybe $200,000 or $300,000 more. So that's a piece of the pie that's kind of missing in our market right now. So we're kind of running a race on one leg. But the good news is our transactional base at that entry level is very, very strong. I was asked to kind of mention what percentage of transactions were done by government financing, and I'll include FHA and VA together. But when you look at the entry level as a market segment, we currently see about half the transactions being done at the entry level are being done with FHA and VA financing. The other half of the transactions, under particularly more closer to $300,000 plus or minus, are cash investors coming into the markets and becoming landlords. So because of the stagnation into the stock market, we are seeing transactionally a tremendous amount of cash buyers coming in and seeing real estate as that outlet for them. And so they're either doing buy and hold, which is by the way, if you want to know, now's the time to buy and hold. If you don't have a risk tolerance, then you have a lot of folks right now, and this is a big part of the investor pool as well, they're out there doing rehab and flip. And so those are things that you won't see statistically, but that is a real part of the market. Looking at the inventory, active and pending listings, as you can see, our active listings are closer to 12,000 over here. I'd rather see us towards the end over here closer. I'd rather see lower inventory, quite frankly. Lower inventory economically there's higher demand. And we see what happens when we get to that $8,000 mark is 8,000 number of listings. We see multiple offers, more aggressive price escalation, et cetera. Whereas when we see it go up to over 12,000, then you have a little more equilibrium, as you say, economically, and you'll see a little more back and forth, a little bit more negotiation, and your price integrity is challenged a little bit more simply because you have more competition. I'll tell you, market-wise, there are several profiles in the marketplace that are necessary to understand. You have the conventional sale right now. That's probably about 50% of the transactions still being done. And I'll tell you, to be successful on the conventional sale market, pride of ownership is the single, we talk about it as real estate folks or as professional realtors, but pride of ownership is even more critical right now because there's two types of sales going on. Those that are the perfect 10, as I would say, and the homes that are in distress. And so your house is matching up against, it's either been taken care of or it hasn't. And the buyer out there right now is very, very prudent. And when you have folks financing up to $697,500 through through FHA and then through VA, I think they just increased it. It's just over $500,000 now. You know, those folks have all their money tied up into that purchase, as an example. So they're not in a position to rehab the home. So they want to buy the short sale. There's often a tremendous amount of value and price savings by buying a property in distress. However, they may not have the means to go in there and rehab the kitchen, replace the appliances, and do the real important upgrades to bring the house current, if you will. So understanding that is kind of critical to understanding what folks are buying and what the inventory is. So if I say 50% of the properties are conventional transactions, the other 50%, about 10% of the total market is REO, which is foreclosure. It's another term for foreclosure. And then the other 40% is approximately short sale. So short sale transactions are a big part of our market. Depending on what part of town you're in, they're maybe a little higher, maybe a little lower, but that's a safe general statistic countywide that I could give you. In terms of percentage of sales that are foreclosures, that percentage increases because they're more desirable simply because the bank has either done minor rehab or they're a quick close transaction. I think one of the things that typically aren't factored into statistics, and I'm not saying they didn't do it, I'm just saying that typically I don't see it when we watch the news, is right now a short sale transaction can take you 3 to 6 months to close. So all the transactions that are being done, they're longer transactional cycles. Whereas what people would equate to a normal market, whether it was in whether it was in an increasing or decreasing environment, you have the ability usually to conduct transactions within 30, 45 days. The only profile you have are conventional sales and REOs, which is only 60% of the market. So it means 40% of our market, 40% of those 12,000 listings, I'll be fortunate if I can close those in less than 3 or 4 months. So from a business cycle standpoint, that has to have an impact on our ability to pull out of this and our ability to improve. If you ask me what my opinion is, and I won't save it till the end, but my opinion is you'll see another at least 2 years of this type of anomaly in the marketplace, just given our experience and what we know practically dealing in short sale transactions and foreclosures. The number of active listings in the list has risen in pace with slower sales. September posted the most active listings this past year. Pending and contingent listings have not changed much since September, and distressed properties on the market are not increasing. This slide was as of like the beginning of January. I will tell you, I think you will start seeing more distressed properties coming to market, but our market has the ability to absorb them. And Lawrence Yoon, who's our chief economist at NAR, very esteemed. He's like one of the top 6 real estate economists in the United States, and he's on CNN all the time. Every slide he's presented on this, every time he's come to San Diego to speak to us, San Diego has the ability to absorb any inventory that we'll see on the foreclosure side of the business. So when you hear it on TV, I'm telling you, as a local person engaged in this business every day, don't be alarmed. The only foreclosures that may have any impact for us will be at the higher price points because we're going to start to see a few more of those. But at the entry level and the midpoint, those are all getting absorbed because half the time they get absorbed at the courthouse steps by cash investors, or they go REO and they're immediately sold within 30 days. Available inventory, estimated months of available inventory. As of the end of the year, we were close to 6 months. We define our market as a healthy market to us, and our trade is 4 to 6 months. What I like about this slide is that it still factors in that over $1 million, we're sitting on well over 10 to 12 months worth of inventory in that particular price segment. So when I look at this and see 6 months, we're actually in a healthy inventory environment. Right now, when you're out showing property, you're going to be able to, although you factor in there's a higher amount of distressed folks sitting in short sale limbo and loan modification limbo, so you're not going to see what I would say maybe the quality of inventory in terms of condition, but you'll see the breadth of inventory, and the buyers have several choices right now. Freddie Mac survey of 30-year fixed mortgage rates. As you can see, the mortgage rates have been trending down. We're still at historical lows. I always chuckle when I hear people, they're worried when the interest rates are at 5%, and we got down historically there to the low 4s. I mean, 5% is still very inexpensive capital, and it's a no-brainer. 30-year fixed, there's just some statistics on the interest rates. You guys have probably seen many of these before. The California housing market outlook is, as you see here, here's kind of what we're predicting at the CAR level. So these slides are from the California Association of Realtors. One thing before I get into those comments, one thing also on the radar right now that I'll bring to you on a political note is the mortgage interest tax deduction. So when you're talking outlook, if we have no mortgage interest tax deduction, we'll have no housing market. And that is the single catastrophic thing that can occur to our local economy. The problem you have is our current interest tax deduction is about $1 million. Well, it's $1 million. And now they're trying to erode that down to about $500,000. And to put this in perspective, we already have high-cost FHA financing available to $697,500. The reason we have that because there's a lot of folks that are in biotech and in these high-tech industries that buy in those price points. San Diego is blessed with this type of lifestyle that we live. Well, it's unlike the rest of the United States. So as I was telling our host here earlier, when the senators go back to Washington, their median price point's anywhere from $150,000 to $250,000. For them, they can live in a 4,000 square foot McMansion for $400,000. They have no sympathy for our tax deduction at $1 million when their local economies are having challenges, and we're sitting here trying to justify why we should keep it at $1 million. So when you see the call to actions, or if you have the opportunity to talk to your politicians, understand it's a big deal. And any discussion, and you know how government works, if they talk about it a little bit, it means behind the scenes they've already talked about it a lot. And so it's a very, very big deal. It's a big deal to NAR. The beauty of NAR, National Association of Realtors, we're the biggest lobby in the United States, and we will do everything we can to stop that. But when the local governments are broke, or in the state or federal governments, or the deficit is where it is, they have to go somewhere to recoup that money. And it's a big target. So please keep that in mind if you want to know what potential variables might affect you in the future. There's one very significant one. Sales will continue to struggle as some rates increase and consumer confidence remains low. I would say right now it's an interesting environment. When we see buyers and sellers talk about real estate as we close transactions in this market, it's funny because I've always thought it was a joyful thing. Putting folks in homes is one of the best things we do here as a trade, and especially here in San Diego. But you still have folks that are losing jobs right now when we're in the middle of escrow. We still see that type of activity. And so there's a lot of uncertainty out there. But I will say San Diego continues to be the best investment in the state. There's certainly very minimal risk at the entry levels. And as long as you know what you're buying, you do your investigations, there's a lot of opportunity in our marketplace, not only as a first-time home buyer or move-up buyer, but also as an investor. So my only other concerns that I would add to that, jobs is the million-dollar questions. Locally, I look at when I sit down every year and we map out what's going to happen over the next 2 or 3 years in the real estate market based on our technical expertise. First thing I'm looking at is what are our jobs doing? If we see big companies moving out of town, we get worried. As I saw in the prior slides, I don't think that's a huge concern at this point, and I hope it remains that way. But I'll tell you, when you have big states coming to our local economy on a regular basis, wooing big companies away, it's happening. You have the governors from Texas. You have the Tennessee Valley Water Authority that will provide companies free power and water to come and live in their state. Who wants to live in Tennessee? But, got mosquitoes the size of pterodactyls, But hey, you heard Meg Whitman said herself, if she had to do it all over again, she would have moved eBay somewhere else. And, you just got to be very, very cognizant as we head into this next chapter with our current governor. The other thing that's going to be effective on a side note is the lack of redevelopment money. Jerry Brown is taking all our redevelopment money. The redevelopment, I'm not even an expert on this. I'll just give you the surface level overview. Without that redevelopment money provides thousands and thousands of jobs in our local economy. And we need those jobs. And it's a shame that they have to go there. But again, they have no choice. So as much as I want to blame Jerry Brown, there is a practical side to say, hey, we have no choice. Short sales, I talked about mortgage interest tax deduction. Shadow inventory, I'll conclude on shadow inventory. Shadow inventory, everyone hears that term. What does it really mean? I consider shadow inventory, the minute it's in default, it's on a path for foreclosure. But right now, the mechanisms in place are loan modification to potentially save it, short sale to prevent the bank from actually having to go to foreclosure, and then for the foreclosure process itself. So you have several steps before it even turns into foreclosure. So when I say shadow inventory, we are not on a destination for doom in the foreclosure side of the business. It's not going to happen, particularly not in San Diego. The banks, and I base this on my personal relationships with the banks that we talk to on a regular basis, asset managers and high-level banking officials, regional vice presidents, et cetera. They're very clear and they're aware of the price integrity they have in San Diego. So you don't see bulk sale purchases occurring. You don't see anything happening to even water down this market whatsoever, simply because the demand is still so very strong. It's worth it to them if they actually get to the foreclosure side of it to rehab and put that house on the market and recruit top dollar. But before it even gets to that point, the short sale process is far more successful than it was in the last 2 years. So you're seeing more transactions being done successfully. I'll tell you at the state level, half of our meeting right now downtown is on making the short sale process even better and smoother. The problem with the short sale process is it has tax consequences, and so there's inadvertent tax consequences. So they want you to short sale, but they don't want you to avoid the tax liability and recourse that can come with those loans. That's a whole nother philosophical debate, but it is a part of the issue. So that being said, we don't anticipate a big shadow inventory. The banks will continue to foreclose. There is no hold. We list for B of A, Fannie, and Freddie Direct. I can tell you in Phoenix, where one of our offices that I own are, I get 8 Fannie Mae listings a day. Here in San Diego, we'll see maybe 1 a day, maybe 1 every other day, and we're on the top of the list. So, and then they get absorbed right away. So you got to remember, before it goes REO, there's an investor that has an opportunity to buy that house at the courthouse steps, and then you have the short sale capability as well. So a lot of filters, and in San Diego, with real estate being in such high demand, quite frankly, not a big factor. And that concludes my presentation.
Our next presenter is Mark Cafferty. He's the president and CEO of the San Diego Workforce Partnership, a nonprofit organization that funds and manages job training for both the city and county of San Diego. He's been in this game for 17 years, and evidently Stanford Graduate Business School thinks he's pretty good at it, as he's the recent recipient of the Center for Social Innovation Fellowship. Mark Cafferty.
So I told some people in here that it's quite likely that you could see a photograph of yourself in the presentation, but I don't think I told everyone, so surprise to some of you if you see yourself up here already. Part of what we wanted to do with this presentation, going after folks like Lynn and Alan and Marnie, is to try to be able to take and build off of a little bit of what they talked about from a national, a state, and a local perspective, but for us to really try to put a face on it. And the way we tend to try to think about this through the programs that we help to fund in the community is sort of less the faces of the economic downturn, or less the faces of the economic challenges that we face, and hopefully more the faces of San Diego's economic recovery. So throughout the presentation, everyone that you're going to see on here is actually someone who you may know, individuals who are either partners of ours in this work in various ways, or individuals who have come through the various programs that we have funded and hopefully begun to get traction that they need to make it in this new economy and the growing economy as we recover. So from a high-level perspective, I want to try and do about 3 or 4 things. But first and foremost, our projection for unemployment in the coming year is not dissimilar to what we heard already. Looking at all the data that we collect, we would really look at this as probably hitting about an even 9% somewhere in the last quarter of this year, maybe optimistically a little bit before, but really that's only going down from the 10.1% that Alan Jin spoke about earlier. So while we're seeing this move in the right direction, and we're seeing slow and subtle job growth and slow and subtle decline in unemployment, we still have a long way to go. I think it was alluded to earlier that we're currently operating at a rate where we need to continue on this path for 4 to 5 straight years to get us back to what most of us would consider to be a healthy job market. The thing that we get to see as an organization that others may not is while we see mixed indicators, what that leads to for us and the folks that we help to support in the community and the services that they provide to individuals is we see a lot of mixed emotions. As people see a stock market continuing to rebound, you see a State of the Union address where you hear about 1 million jobs created last year. You hear a great deal in the newspapers about biotechnology and clean technology and very important industries to our economic growth, while at the same time, as we sit in this room, 1 in 10 people you know is out of work. And in some pockets of our community, 1 in 5 people is out of work. And in some very specific segments of our population, which I'll talk about a little later, that number shockingly can be even higher. So again, mixed indicators and mixed emotions. Really looking just at pure data, we would project somewhere from an industry perspective of about 1% job growth in the year ahead. I won't roll through all of these because they're not dissimilar to some of the industry projections you saw earlier. I will reiterate what we heard from some of the speakers that we do think healthcare in particular is an area that will not only continue to grow because of the need for care, but because of here in San Diego, how broad-based that industry can be looked at. When you really link it into the crossover with biotechnology, when you begin to look at the nexus of healthcare and information technology, the work that the West Wireless Institute is beginning to pioneer here in San Diego, we're really looking at not only traditional job growth in healthcare, but truly new jobs being created as well. Again, some other industries, while we would probably think breaking it out, finance and insurance will see some gains, we would see that being offset by some continued losses in real estate as well. And while we do see a great deal of interest in jobs that will be focused on renewable energy and green technology, from the broadest sense, we'll continue to see some level of decline with our utilities as more advanced technology begins to take over the work that was historically done by more people, and we see an aging workforce begin to filter out in the year ahead from some of our major utilities. Making sure I don't skip one pass. So what that basically means as we break down is we think we'll probably see 15,000 to 18,000 new jobs in San Diego in our economy this year. That's slightly higher than I think what when Al and Jin may have spoke about earlier, but again, not off considerably from what those numbers look like. Innovation economy jobs, as we talk about them, and they're very important, and we know that they lead to a lot of the different things that individuals have spoken about today, the ability to buy a home and raise a family here and really contribute to the economy. But when you talk about 4% job growth in that area, you're really talking about 400 jobs. So again, kind of keeping in mind that while the percentages are increasing, these are not massive overall numbers of new jobs being developed. It's a positive picture, but we still have a long way to go. So again, some of these jobs, as you can see, highlighted a little bit in red there, and the bottom two highlighted in yellow. There's a difference there in the level of wages and skills that we would see in these positions, and it speaks a little bit to the duality of what Marnie Cox spoke about earlier, which is what will our economic development strategy be? Will it be to focus on lowering that unemployment rate quickly and getting individuals into open jobs, or will it be on the long-term investment in areas of the economy that we know will have the most significant impact in the years ahead? So for us, we operate and fund a series of job training programs and one-stop career centers around San Diego County. So what that does is it gives us a very unique lens to thousands of people who are coming in looking for services. So this is not the entire population. As you can see from the numbers up here, it's a subset of our population, but it's substantial, and there's a few trends that we can begin to see and that we think are fairly interesting to talk about. So in 2008, 2009, we saw just under 17,000 people coming into the various programs that we fund in the career centers looking for services and support. We saw then almost a 20% increase and almost 20,000 folks coming in the following year. And then interestingly enough, in the year that we're in right now, we're projecting a pretty staggering drop-off in the request for services. Now, we'd love to be able to say we think that that's because folks just don't need services anymore, things are getting 41% better, but that's not really the case. The way we see this, and you can see it up there, and I'll just elaborate on it a little bit, is in the early stages, we were in the throes of a horrible recession. So this huge increase that we were seeing from 2009 into 2010 was the result of just massive numbers of people being out of work and needing to do something, and hearing that there was either training or additional services that might be available to them. What they also were hearing at the time was the onset of the American Recovery and Reinvestment Act, or what people have historically continued to refer to as the Stimulus Act, or the stimulus funding. We believe that the interesting picture on the drop-off is a little bit more mixed, and getting back to some of those mixed indicators. We are hearing directly from people that they're not seeking services because they do think the economy is recovering, because they do think that they can actually weather this on their own and kind of find their way back into employment that is not dissimilar to what they once did. On the total opposite end, we are hearing from people that they are just so frustrated they've given up. And even when you see the unemployment rate, please keep in mind that you're actually not seeing reflected in that unemployment rate the people who have just given up. You're seeing only the individuals who are saying, I'm out of work and I'm still looking for work. If you've given up, you don't even count in that general unemployment rate that we report on so often. They're also hearing that Recovery Act money is sunsetting and going away. So again, I would like to say it was a really positive picture for why we see this decrease, and I don't always want to blame things on funding, especially not the government funding that comes into the region that I think can actually do some good things. But the drop-off in funding, and I think some of these mixed indicators, are leading to fewer people coming into our centers. The interesting thing is we painstakingly go through the demographics of who those people are. And as we hear some national trends on who this recession has hit hardest, we see that kind of mirrored in who we're seeing in our career centers, and at times we see things that are slightly different here in San Diego. One piece that we thought is interesting to note, and as you look at this, and I think as you look at your far left, please note that 2010, 2011 for us is midway through the year that we're in. So pay more attention to the percentages, not the overall raw numbers, keeping in mind this is the year that we're projected to drop off. But if you look at the education level of the people coming in and looking for services in our career centers, looking for job training programs, looking for additional support, in basically all categories, we've seen the education of these individuals rise as the recession has lingered. And it may be for a few different reasons. First and foremost, when the recession started, it is likely that the people who flooded us and our programs for services were very similar to the individuals that we've always worked with. They were individuals who knew of our services already, possibly used them in the past, had family members or friends who utilized those services. And it's less likely that some of the higher educated individuals in the community thought they'd be unemployed as long as they've been unemployed. So as the recession has moved on, and we've had to focus more on a base of customers coming in the door who need more support in upgrading their skills beyond the degree level, we've started to focus more of our funding towards programs that are embedded into the colleges and community colleges, and that's become more attractive to some of the folks walking through the door. And I just think that, again, this is a population of individuals who has begun to read and see on a very regular basis in the publications that they look at, if you're still out of work, go back to school and increase your skills, keep them sharp, see if you can get another certification or another degree, and we're certainly seeing that reflected in the data of the individuals walking through the door. The real interesting thing for us is even with that rise and that steep drop-off that we're looking at, almost in an eerie fashion, we're not seeing almost any change in the demographics of the individuals who are walking through the door by way of either age or ethnicity. The percentages remain the same even though the overall numbers climb and fall. But the thing that leaps off the page at us is in mid-2007, all of the services that we helped to fund in San Diego, about 34% of the individuals taking advantage of those services were men. In the high point of the recession, that's 56% of the individuals taking advantage of our services. So we have heard nationally that this recession has had a very strong impact on male workers. We can't say definitively that we agree, but we can say we have seen a massive increase in the number of men coming in and seeking services during the recession. And again, as I said before, as the recession lingers, we're seeing that more highly educated base of workers. But what else are we seeing beyond our career centers? And there's 2 or 3 things here that I'm hoping maybe these statistics can stay burned into your brains long after you leave the room today. The unemployment rate for veterans in the state of California between the ages of 18 to 25 is 25%. Our overall unemployment rate, as we saw, is 10.1% higher in the state of California. 25%. These are the men and women coming back from Iraq and Afghanistan. They've served their country. They are well trained. The government has spent hundreds of thousands of dollars in their education and training, and they are 2 to 3 times less likely to find their footing in California's economy than their peers. So there's something wrong with that picture, and I think I'll talk a little bit later about some things we can do about it. Another thing that is totally off of people's radar screens is regardless of what neighborhood you live in San Diego, where your children go to school, there are fewer young people working between the ages of 16 and 19 than ever in our country since we began collecting this information. And that's not purposeful. That's not just because young people have chosen not to work. Those numbers started to decline because of other opportunities for young people during a good economy. But what we're looking at right now is an economy where if we look out 4 and 5 years from now, and you think about the skills that you want somebody to have in their early 20s as they come into your business, we're stunting the growth of our economy by not figuring out how we get more young people exposed to jobs earlier. Regions that do this well tend to be the most innovative regions in the country when we look at their economies. San Diego has got to figure out how we can get better at getting young people out and exposed to industry, working part-time, and learning the skills they need in their late teens that many of you in the audience got through those summer jobs that you had in your late teens that young people are not getting now. And so therefore, when they're in their early 20s, whether it's the impact that it has on their wages, the impact that it has on the opportunities that they can pursue, or the impact that it has on their ability to work for you, it is significant. A couple of really interesting and I think positive things to focus on is that our colleagues at the San Diego Software Industry Council will tell us that right now as we speak, there are 6,000 openings in San Diego for software engineers. Now, they did this by polling their members, and they're an industry association. They also did it by polling the broader business community. Our numbers that we look at on a regular basis would probably indicate that this might be closer to 2,000 in our conservative estimate, but nonetheless, thousands of jobs open in San Diego for software engineers. And when you think about that in terms of some of the things discussed today, first and foremost, if you're a software engineer in the audience, you should be calling the San Diego Software Industry Council right away and finding out who the folks are that they're talking to. But for a school like this and other schools around the region, what are we doing to ensure the young people coming out of the various software and engineering programs that we have a pathway and a pipeline developed so that they're going into these positions? Because the alternative is that either these companies will, one, start bringing in folks from elsewhere to fill these jobs, which is okay because it still has a decent impact on our economy. These are high-wage, high-skilled jobs. Or worse, they're going to leave here because they're going to think that somewhere else has a better, more appropriate workforce for what they need in San Diego. And another thing that we're hearing from our colleagues at Biocom and their peers at Bay Bio is throughout the recession, they've continued to see and track sustained economic growth and job growth in the area of industrial biotechnology. So this is the manufacturing side of biotechnology, and a lot of it is focused on the alternative energy that we hear so much about in the news. So for us here locally, biofuels is probably an area here in San Diego, in Imperial Valley, where we're going to continue to see some growth in this. And if someone is studying in this area right now or interested in this area, you have reason to be optimistic. A few months back, and I'll go through this really quickly because you have a handout in your folder, we had an opportunity to bring former Labor Secretary Robert Reich to San Diego and ask him specifically what could San Diego do right now to create jobs. We also wanted to then bring together some local experts who could come to the table and share their thoughts on whether they agreed with Dr. Reich or not and what they would do to generate job growth in San Diego right now. Admiral Herring, who was here in the audience earlier, was one of those speakers. But in a nutshell, and we have a much longer report on our website, what this kind of got crystallized into is 7 areas. One was a debate around subsidized work. What could the government be doing right now to take people who are out of work, as it once did back in the Great Depression, and put them to work in a way that if businesses are still struggling to hire, it wouldn't hurt them on the payroll side of things. So getting people who are out of work into an opportunity where they could keep their skills sharp, they could draw some income, that income could be reinvested in the community, and at the same time, businesses wouldn't have to make the big leap to bring people in right away because they could do this through more of an internship fashion or a position that, again, was subsidized through either foundation or government dollars. Dr. Reich talked a lot about the high road to economic recovery, and I won't go into it in great detail because I think Marnie Cox talked about it perfectly. Again, it was that idea of, do we focus on lowering the unemployment rate through certain industries in the short run, very important strategy, or do we focus on long-term investment that's going to create what he referred to as greater wealth for our region and an opportunity for all boats to rise. Organized labor, which was at our event, and the discussion around the role that organized labor and business need to play together, being at the table together to address some of these issues, and how difficult that situation has become, not only here in San Diego, but elsewhere. Government reform, focus on innovation, and for our organization, a really important emphasis on lifelong learning. If educated, skilled, knowledgeable people have learned anything in this recession, is that we all have to think about reinventing ourselves, keeping our skills sharp, and being able to navigate a difficult economy as well as a growing economy. The last thing that we wanted to do is showcase today for the first time an index that we at the San Diego Workforce Partnership have put together that is not focused on the full economy but purely on the job market or the labor market. And so behind me you can see some of the things that factor into how the weighting of this index happens, and it is very heavily modeled off of what Alan Ginn does here at USD. In fact, when we try to focus on the overall health of the economy, we do use his index of leading economic indicators to do that. We also double up on some areas that you heard heard Dr. Jin speak about earlier today, such as the filing of first-time unemployment claims, as well as the overall unemployment picture here in San Diego and job postings. And while we may use some different sources, we're still focusing on the same things. So for us in San Diego, if you were looking at a snapshot from 2006 to November of the year that we just concluded, this is what we believe the health of the workforce would look like if plotted on this index, keeping in mind that we would indicate that what we would think is a healthy workforce or a healthy labor market would be somewhere around 100. So if you look at how much this has declined and when it has declined, and you look at that in conjunction with some of the other things that have been presented today, and you look at the moderate increases that we're starting to see, you could see that we too would say we've turned a corner and we're beginning to grow, but we are a long way off, as you can see, from 100, fluctuating right at about 70 right now. If you visit our website in the weeks ahead, there'll be a great deal more about the methodology behind this report. Chuck Flax, who is our lead researcher, is here in the audience as well, and his contact information is at the end of the presentation. But we're going to begin to put this out on a monthly basis in hopes that we can continue to try to show what we think the health of the workforce is while we're looking at the health of the overall economy, knowing that jobs continue to lag behind some of the other indicators. So final thoughts. I talked earlier, and I won't go into great detail, we have got to think about programs that transition veterans into some of the areas that we've talked about here in San Diego, and we need to do this soon. This is a major, major problem, and these are individuals who will leave this region quickly and go back to their home of record if there's no opportunities here for them, and we will lose that talent. Summer and year-round youth employment programs don't sound like one of the most major economic strategies that you might think the region should invest in. I'll debate anybody on that. I think it's a major economic strategy that we need to be investing in. Linking job training, the sort of work that our organization does, to broader economic development efforts, not doing it in a silo, making sure that as we look at projections of industries that are going to grow and have a significant impact on San Diego, that we're not irrelevant to those industries. And quite frankly, we have been in the past to some of those industries. And lastly, focusing on training that's going to get people into the types of jobs that are going to pay them a wage where they can actually afford to stay and live here in San Diego. $13.54 may look high to some people in the audience when you think about what the minimum wage is. Please keep in mind that blowing that out to a full-time job over the course of a year, that's roughly $28,000. There's not a whole lot of folks in San Diego who live very comfortably at $28,000. So when individuals are even making this wage, they have to hope that there's another earner in the household. They may have to take a second and third job. But at least, at the very least, based on all the calculations that the Center for Policy Initiatives have done, that we've done at the Workforce Partnership, we would indicate that it should be right around that level. So a final few thoughts. One thing that I didn't speak about in great detail, but you can see, is when you saw some of the construction projections that we had, and it may be confusing to people to see us projecting any sort of increase in construction, it's probably twofold. One is, as both, actually as all three of the economists spoke about, we're so much at the bottom of the number of jobs we've lost that a 2 or 3% increase in construction is not massive. But we are projecting it in the year ahead. And as we polled 159 different companies that, according to themselves, are involved in green construction, we heard back from them that they saw about a 5% increase in what they expected as far as hiring would go in the coming year. Now, those are not all construction-specific jobs, because not all jobs at a construction company are the actual jobs out doing the construction, but in the broadest base of who they employ, as much as 5%. Our workforce index is available on our website. Our Workforce Summit findings are available on our website, and I would say we would love the opportunity to come out to different organizations and speak about these findings and these solutions, talk more about the index, and try to accelerate the discussion about not only job creation in San Diego, a term that gets way oversimplified. Jobs aren't easy to create, as those of you in the private sector know. The Workforce Partnership doesn't create them. The government doesn't create them. So getting our economy back to a place where, as we see job creation happening, we're making sure that resources are tied to supporting that. My email address is there, and Chuck's email address is there. And sort of in closing, when we try to give folks a snapshot of what we think the coming year looks like in our terms, this is what it looks like. These are all individuals, young and old, new in different careers, people who have come to our organization or those organizations that we fund for support and have begun to find their footing in this economy. So make no mistake about it, we're seeing very positive things, and we think that will continue in the year ahead, and we welcome the support of any of the different organizations who may be in the room in trying to get there at a faster pace. Thank you.
So continuing with that theme of job creation, we've already heard a couple of times today that one of the very vibrant features of both the U.S. and the San Diego economy is that one of the big engines of job growth is small business and entrepreneurship. So with that in mind, I'd like to welcome our final speaker to the podium, Camille Sobrian-Saltman. She is the president, COO, and board member of Connect, which is one of the world's most successful regional programs at linking high-tech and biotech entrepreneurs with the resources they need to succeed. Technology, money, new markets, partnerships, management, all of that stuff that goes into starting a successful business. She's won way too many awards for me to really read out here. I'd just like to call attention to one. Her work with the Regional Chamber of Commerce Welfare to Work campaign was a national finalist for the Public Relations Society of America's Bronze Anvil Award. So, yeah.
Well, thank you for having me here today. I really appreciate the opportunity to talk about the innovation economy. Some of you, I see some familiar faces in the audience, are very familiar with it. It's a perfect time for the innovation economy in San Diego and in America. If you listen to the president's speech the other night, he talked about innovation as the engine that's going to turn around the economy. And he also talked about education as a priority. And both those areas are of deep concern to us. Mark raised the issue in a number of contexts in his talk. If there are 6,000 software engineers jobs open, there are a number of, probably a couple more thousand electrical engineers, mechanical engineers, aerospace engineers, and other types also open. And it's very hard for companies to grow and meet the demands of their customers if they can't hire the talent they need. And it's that talent availability that keeps those companies here in San Diego. We have companies like Northrop Grumman looking for a couple of hundred engineers. If they can't find them, eventually they move part of their business away. Motorola is looking at our city as well as a number of others to move their head office. And it's really jobs that are availability of talent that's going to make a big difference. So training people for the jobs that we have now and the jobs of the future is really critical. I wanted to, knowing that the day would be focused around some of the challenges we face, I was actually asked to try to focus on some of the glimmers of hope. So I'm going to try to be fairly positive and bat cleanup here. We produce a report quarterly called the Connect Innovation Report. It's the only report of its kind in the country. It's the only report that really quantifies the health of the innovation economy. And we're able to do this through the foresight of the County of San Diego and the San Diego Workforce Partnership, the law firm of Procopio, and the Leglar-Benbow Foundation. It's an expensive endeavor. We work with the economists at the National University System Institute of Policy Research and at UC San Diego's Extension, the Supercomputer Center, PricewaterhouseCoopers with their Money Tree report, and a system called Capital IQ that tracks mergers and acquisitions, and IPOs. So a lot goes into it, and we really appreciate the support of our partners. The report tracks the number of startups in innovation each quarter that are created and the jobs that are created. It also looks at the patents that have been published and then granted. And there's a huge backlog in the federal government of patents that have been filed but not dealt with yet, because the government takes a huge amount of the funding for looking at those patents and proving them and uses it for other budget items because of the deficit and the financial crisis that we're in. So it makes it very difficult for entrepreneurs who are trying to start companies and to compete if they can't protect their invention from their competitors. So that's a big indicator of health. We track the number of research jobs and how well those folks are being paid. We look at IPOs, which are the way that companies, investors are able to recognize their return on their investment when the company is able to go IPO. We look at mergers and acquisitions, and then we look at the full technology employment base by cluster, by category, and how it's growing, how many people are employed, where the wages stand versus the average wage. So it's a pretty robust report. It started out with the data you see up on the screen. That was our first indicator. And we're seeing some very, very positive trending here. In 2009, we lost a lot of momentum in new startup creation. There was very little capital available, and it basically cratered. We're now on a solid path to double the number of startups this year. And in the third quarter of last year, which is the latest data I have, we had almost 100 new startups, and they created almost 340 new jobs. Across the state, San Diego's pharma biomedical device cluster grew the most of any other city, and we created 33 new companies, and that was more than double the previous quarter. Overall, in terms of all the innovation clusters in San Diego, we rank number 2 behind Los Angeles. And there's an interesting phenomenon that people don't realize. When you look at all of Southern California, that's LA, Orange County, and San Diego, as you can see from this chart, we were at 52% of the startups. So that 52% of the startups were created in Southern California. In Northern California, where we think of as the innovation hub of California, San Francisco, Silicon Valley, they only created 35% of the startups. So we're in a part of the world that's very attractive in terms of innovation, and we're starting to tell that story. We in San Diego alone attract about $500 billion in federal grant funding. And we have, I'll talk a little bit more about this later, we have more than 80 research institutions. We have very strong clusters in almost every form of technology. And when you add in Orange County and LA, it's a very rich investment opportunity. But the big funds that invest in venture capital are really not aware of the story, because we just don't partner with LA and Orange County to talk about our assets. We tend to compete or work in isolation. So that's something that we're working on. 25 years ago, my organization was created by UC San Diego and a number of community leaders, including Erwin Jacobs from Qualcomm, to help with some of the issues that were raised earlier. Cold War spending was declining. We actually had a savings and loan crisis at that time as well. And there was a thought that if we could start to commercialize the research, the great research that was happening at UCSD, that we could diversify the economy, and that would protect us. And now, 25 years later, we have 6,000 innovation companies in San Diego. The bulk of them are in 4 big categories: communications, pharma, biomedical, medical device, software, and defense and transportation. And the environmental technology, clean tech clusters growing very fast, and we also have a growing action and sports cluster. A new cluster that we've recently begun to focus on, and you've probably heard the president talk about it and seen articles about it in the newspaper. We're starting to focus on outsourcing companies that are based in San Diego and try to pair up our innovation companies locally of all sizes to get them to outsource here and keep jobs here rather than going to Mexico or China or India. There are some jobs that will always go to other places, but we've found that most companies are completely unaware that we have more than 5,000 outsourcing companies here on their doorstep. And they're companies that do prototyping, they do machining, they do clinical trials, product design, every service imaginable. We are also working on a major effort to figure out what the innovation jobs of the future are going to be, 5 years from now, 10 years from now. And then to work with partners like San Diego Workforce Partnership to ensure that we have a trained workforce so that we can actually create outsourcing companies here in San Diego to do those jobs of the future, have a trained workforce available, have the supply chain available, the land, the infrastructure. If we do that, it's felt that we will be able to bring home a lot of jobs and capacity, and in the medium term, literally recreate our middle class in San Diego. This is a priority across the country now, and the Secretary of Commerce and President Obama are focusing on it. We're working very closely with the Kauffman Institute and a number of community partners. Ted Waite's foundation has invested in the effort, and UC San Diego is doing a great deal of the research. So a little bit longer term, but I think a positive initiative. We actually decided to do an inventory of the research institutes in San Diego. We were thinking we probably had about 50, and we just finished this census, and we have more than 80. 56 of them are in UC San Diego, and along with this very positive innovation engine, San Diego is actually leading the nation in the growth of patents granted. That number jumped dramatically in the last quarter, last year. A new trend, somebody mentioned, I think Mark mentioned West Wireless Institute. We now have more than 10 what we're calling convergence research institutes in the region, and this is a very new and recent trend. As technologies come together to create new solutions, biofuels, M-health, wireless health, clean technology becomes a part of many different forms of technology. Action sport technology becomes clean, or it takes on wireless capability. As that's begun to happen, there has been enough coalescence of researchers and industry and government funding to fund these efforts. Another big area of focus is autonomous robotics and cybersecurity. So we now have a strong group of research institutions that are creating new innovations in this area, and clusters building around them of industry that has commercialized the research. You're probably familiar with some of the names like Sapphire Energy. That's a company that's gotten a lot of attention locally. You've heard a lot about this morning about the salary levels of the innovation jobs. We now have real data around this. There was a jump in the third quarter of 2010 as well that was very positive. Tech only represents 5% of our companies, but it's 10% of our jobs, and it's 25% of wages paid, and those wages are 95% higher than the average wage. And they're secure jobs. These jobs fell during the recession, from the beginning of the recession to now, by 2%. And you saw the statistics about the broader job market. It fell more around the 7 to 8% level. So this part of our economy really stabilizes our economy as we go through bad times, and brings a great deal of spending power into the marketplace. which is really important. So you can see why it's important to get our workforce educated, or to ensure that our young people are taking science and math, and that there are programs to go into the schools and excite them about the kinds of products and jobs they could have if they really applied themselves and pursued careers in engineering and science. You can see here the pay levels of the different parts of the innovation economy. Communications is at the highest. Pharma, bio, and medical devices comes next, and in the third quarter of last year, pay in that area jumped by about 10%, which we think is an indicator of a tightening market for talent in that area as companies are beginning to hire again. Then software, defense and transportation, computer and electronics, environmental technology, technical consulting. Interestingly, the wages jumped by more than 20% in that third quarter. So there again, a sign that there's hiring going on. And then action and sports is at the lowest end. We're going to have to try to work on that. If you're in the surf industry, there isn't a big enough market to really drive wages, unfortunately. I think I mentioned the statistic that tech jobs pay 95% more than the average wage in San Diego. The average wage is $47,000, and you can see the same hierarchy that we talked about on the previous slide, and the average tech wage is over $90,000. Here you can see what happened to tech jobs during the recession. They were much more stable than the average job. I promise to be positive, but I'm afraid that I do have to be honest as well. In the third quarter of last year, only 1% of venture capital money came to San Diego. The bulk of funding is coming from federal grants, and it's also coming from friends, family, and individual investors. And these are really, really tough times, and that's why we were encouraged by Obama's emphasis on innovation. Innovation requires investment by agencies like the NIH and the NSF and the DOD and the DOE and some of the new folks that have been elected have been indicating that research funding is not necessary for innovation, that innovation companies should be able to prove whether there's a marketplace for their technologies or not, and the government shouldn't have to step in and fund research. Unfortunately, the research process to develop discoveries can take many, many years. We're often talking about life-saving therapies or technologies that are more energy efficient or cleaner, and it's very costly and time-consuming to develop them. So funding is crucial. We've been working with the government on a range of policies to try to free up some money without costing the government more, because obviously there's no more money to be had. So we've been trying to look at policies that can create more investment spending, create more jobs, create more research and development. One of the biggest initiatives, and there's a bill about to be introduced in relation to this, is around foreign profits. It's estimated that there are about $500 billion in corporate profits offshore around the world. This affects every large company in San Diego right now: Qualcomm, Sempra, all the big companies. When they make foreign profits, 2/3 of Qualcomm's business is in China, for example. If they bring them back to the U.S., they have to pay a 35% corporate tax. So they don't. They build their new plant in Taiwan or in Brazil or in India. So what we're proposing is that if they bring the money back and they spend it on R&D or a manufacturing facility or a proof of concept center, some kind of investment in infrastructure, that they don't have to pay that corporate tax. This will be for a limited period of time. It was done I think it was 2004 for a period of time, and it brought back something like $400 billion in offshore profits. So this could be a huge boon for our economy right now, and definitely a huge benefit to San Diego if we can make it happen. We are just now working on trying to collect grant funding data for the Department of Defense, the Department of Energy, and DARPA. But we are able to track National Institute of Health and National Science Foundation grant funding, and it has been climbing steadily. About 75% of the funding coming into the region is from this grant funding. And you can see here how the different regions in California are faring. From NIH, it's just been a solid climb, quarter on quarter, coming into San Diego. We have been tracking patents since early 2008, and we're delighted to see that patents published are up by more than 20%, and patents actually granted up by more than 50%. So this is going to be a big help in our local economy to innovation companies. We are off the charts in terms of the increase in the number of patents that are actually being published and granted over communities like Silicon Valley. So this infusion of new grant money has really increased the amount of innovation taking place. We have real results that we can show for it. And I think that is it for me. Thank you for your time, and I look forward to your questions.
Okay, so we're in the home stretch now. We're going to move to the Q&A section, which we are going to lead off. I'd like to invite our very august business and economics writer from the Union Tribune, Dean Calbreth, I should say Pulitzer Prize winning Dean Calbreth, up to the podium to kick off a little bit of our Q&A, at which point I'm going to go through this huge stack of pink sheets that I've got here and try to synthesize all of those into a couple of questions, yet still get us out of here by noon. So wish me luck, and I'll turn it over to Dean.
Thank you. Yeah, thanks very much. I've really enjoyed this morning session. It's been terrific, and it's feeding stories that I'm going to be writing today and tomorrow. So I'm glad that I don't have to make all the phone calls I usually make. I just take these notes. I found this last session pretty interesting in terms of creating jobs and creating, building the opportunities to advance San Diego. One of the things that I get at the Union Tribune, whenever I write about real estate, I often say, one positive sign is that the prices have plateaued, or maybe they're rising. And whenever I write that, I get plenty of letters to me saying, why is this positive? Why is this positive? They're saying homes are still too expensive for people to be moving in here. You were talking about entry-level homes being at $400,000 or less. I bought a home 15 years ago or something, fortunate enough to be less than $300,000, and on a dual income, that's still a hard home to pay for, even now, even with a 30-year fixed loan. And when you talk to companies,
one of the, when you ask companies why whether they're going to move here or not, you expect to hear, if they say no, you expect to hear them say, well, it's because of high taxes. It's because of regulations. This is what we always hear. The top number one thing they say, high prices. And homes are among those. Even now, I mean, the Union Tribune is now getting a lot of people coming home, coming just from Orange County down to here. Our editor is now from Orange County, and other people are coming down. And even from Orange County, even crossing just that short drive, they are amazed at the high prices in San Diego. So one question I've got is, are prices too high?
Well, I could, is this on? Check, okay. So what I can tell you is, even if I said the entry level was even lower than 400,000, let's say at the 300,000 or less, first of all, those are neighborhoods probably most of you wouldn't live in anymore. And second of all, they're not building new product in that price point. So we're going to see no new product in the next couple of years in those price points. We'll see no affordable housing being put on the ground, even in the rental markets. In the suburbs of San Diego, I live in an unincorporated city, 92127. There's no apartment buildings going in there, and there's plenty of land. Now they're getting ready to put in Black Mountain Ranch, for example. That'll be 5,000 homes, mixed use. That's nice to see them pulling permits for that and getting ready to go there. That's all been approved. But you're not, and permits are down for the most part. And so the demand is, I mean, very simply, the demand is there. So when we put the properties on the market, and they are being absorbed, and we have the ability to absorb inventory in those price ranges. And whether we see, and I think probably what we'll see going forward is more extended family living in with folks. We got mom and dad and the adult children. I think you're going to see more of that as we go forward in consolidation, if you will. But they're buying them, so it's hard for me to say that it's too high. We certainly can probably make mathematical calculations of what an affordability index is, but we're certainly not at breakpoint right. We're far from breakpoint right now, and we've still seen the 30 to 40% or greater adjustments in many of our neighborhoods from peaks. This actually also goes to, in terms of building a better workforce. I mean, you were talking about, sort of your minimal threshold, I think, is to find jobs that pay $28,000 or more. But a $28,000 salary isn't going to be able to buy one of these $400,000 houses. To what extent, are we building, and again, you were talking about how 5% of our jobs, which is, or I guess, 5% of our jobs are tech related, or these relatively high paying jobs, which is a good number, but, how do you expand that number, and how do you raise those salary levels, which San Diego has always had lower salaries than the cost of living here?
Is this one on? Okay, great. It's a great question, and it's a point we hear a lot from businesses echoing the exact same thing that the Dean just spoke about, and we know and understand what the facts are with the demand and folks buying homes. The reality for us is, and I know the two economists on the panel will agree, and I know Marnie always does when I talk to him, is we have a lot of low-wage jobs in San Diego, and those jobs are important to the overall economy. They're not jobs that we just could get rid of because of the impact they would have on those industries and businesses if we suddenly just said raise all those wages. And I know there's folks who advocate for that, and they're very passionate about it. Our hope at the Workforce Partnership is that we're doing the best we can to get folks into a job at that level and to try to keep them on a career path where that could then lead to additional training, additional benefits and support that can project them to another place in that particular industry cluster, or to start somewhere and then continue to gain skills so that they can move somewhere as the economy becomes more robust again. But it's difficult, because when we meet with businesses directly, just the idea of telling businesses in this job market that we really want to take the $9 an hour jobs that you're paying right now, and we'd like to see them at $14 an hour. Who are we to walk in and say that, other than we know the impact that it has on families when the wages are that low, and it causes someone to work a second and third job, and all parents in the household to work to the extent that they can. But again, it really is as the recession has set in San Diego, our policies at a local level to train folks for jobs, even at that threshold, have weakened a bit. Because when a potential training program came to the table with the promise of jobs at the end of it, even if those wages were slightly lower, we knew they were jobs for people. A few years back when we were at 5%, 4% unemployment, we could really push hard on saying that we want all of our training dollars to go very specifically to these types of high-wage jobs, but we've got folks knocking on the door every day who need a job. So I don't know that that's a great answer. It just continues to be sort of the tightrope that we walk in San Diego, and I think for us, we try to make sure that that policy is more focused on getting individuals at least to that threshold, and then us not giving up on them getting the training that they need to potentially move into the kinds of jobs that pay more and that could potentially allow them to afford to buy a home and live in San Diego.
And one thing I'd like to comment on is there's the cost of construction. In San Diego, the one thing that's always going to impede our ability to create affordable housing to help those folks, compare us to, let's say, Arizona, where the average 1,500 square foot house in a fairly newer neighborhood is going to run you a low $100,000 to $150,000. We couldn't build that house here. That cost, land acquisition and cost to build, it's too expensive. So one of the barriers that we have here is our inability to create new housing at an affordable price structure, but given the cost of land and the cost of construction, cost of labor. And so those are all things you got to factor in when you're wondering why.
Just from an economics point of view, two issues. First, we always structure the question, it's very hard to afford a house here. But that is why we have a rental market. As you recall, one of the issues and causes of the financial crisis is that we tried to promote home ownership as the ultimate goal, and everyone should be a homeowner was the ideal category, and we found that actually a lot of people really were not in a position that they could be homeowners. And so I think as people are first rental property dwellers, they accumulate savings, and at some point perhaps if they feel they want to be a homeowner, they can be. So I think it's important to align our objectives correctly. And second, in terms of how we see really San Diego's comparative edge, as we've heard from Connect, we have a tremendous potential in technology, 6,000 positions open. The cost of land, even taking your point very well made, Mark, of higher cost of construction, the cost of land, there are just a limited number of areas that have this kind of climate, which means your cost of land is always going to be expensive, and the only way the economics of that can work is if you have higher paying jobs, which we have, more productive jobs, and then all those economic pieces come to fit really actually well together that make you a very productive, high-paying jobs region.
And Camille, did you have any?
I think that there are some things in our region that we have a history of doing that help. Education, critical. As an example, we've been working with a young man who decided not to finish college, much to his parents' disappointment, and he just went through a program to learn how to install solar. It's just a couple of weeks, and now he's installing solar on rooftops. It's a tough job, and he's wishing he was back in college, but he's now able to leave home, go out, pay rent, and build some savings. And he'll be able to go on and get further certifications and further education and improve his salary and potentially run crews eventually and build to the point where maybe he can buy a home and build a family. So I think education's critical, and I think also the working together of the community. At Connect and at Biocom and Software Industry Council and all these different organizations, we bring together volunteers from the community who help the companies for free so that they can grow faster and find the things that they need, and then they can hire people. And then those jobs that they create will be high-wage jobs, that invest back in the community. So I think by working as a team in the community, we've been able to overcome barriers. San Diego is actually studied all over the country and all over the world as a model for creating an innovation economy. You wouldn't believe New York City is the latest city to look at it. The Secretary of Commerce and Brookings and Kauffman Institute are studying the city. Books are being written about it. So it's a pretty special place, and I think we just need to do a lot more of what we've been doing.
Terrific. Thanks very much. And now Ryan will have the questions from the audience.
Okay, thank you, Dean. So with the number of questions both between the registration and what we've received recently, I've sort of had to adopt the strategy of trying to go for the questions that were most asked on a theme is kind of the way I'm going to structure this. We've talked a lot about kind of job growth and skills development already in several of my first questions, and that was by far I think the most popular topic. But a close second were kind of the implications of the budget crisis. Some interest in that nationally, but most of the questions were from the state and local level, I think. So if we can just start with Lynn and kind of move down the panel here, I think everybody has a piece of this. So from the economists, I'd like to hear just generally sort of what you think of what you're hearing in terms of, say, what's coming out of some of Governor Brown's proposals. And just sort of what you think the major challenges are. And as we move from economists to real folks, sorry about that. I'd like to hear sort of what you think in terms of what you've heard from the governor and from what you hear more locally here in San Diego, things that you think are sort of good strategies, things that concern you. You know, we mentioned things like the move to do away with redevelopment funds were one of the things that came up with. So, like I said, kind of give us your particular take on the state budget mess. We'll start with Lynn.
First of all, we've been kicking the can down the road at the federal, state, and local levels for a number of years. We've seen the implications of that strategy in Europe with the problems in Greece, Ireland, Portugal, and Spain. And I think now it's really time to face the music and start to solve really two issues. One, a structural operating deficit that we are seeing at all levels of government. And then second, the overall legacy of the overhaul of pension reform. So those two issues. Second point I'd like to make is that there is going to be this pushback. The federal government is going to be pushing costs back to the state governments. The state government's going to be pushing some of their costs back to the local governments. So we're going to see the impact very significantly in the next year. Third, a lot of economists said, well, you know, we're still struggling with the economy, so we don't believe it's the right time to take stringent budget issues. My point is that you don't have to necessarily put a lot of austerity in the near term, but you need to have a plan. You don't want to do it overnight. You can't do it overnight, but I think it's critical for business confidence, for the financial markets, for that dull and boring bond rating, to have that plan put in place. So I think, you know, we really can no longer push this issue under the rug. We have to deal with it, and probably the sooner the better.
Okay.
I sort of agree with that, but again, this sort of shows you the sort of the problems with the balanced budget requirements at the state and local levels. You know, again, for fiscal reasons, fiscal prudence reasons, that's, you know, it has some desirable aspects, but in a downturn, they tend to compound the severity of the downturn because you either have to increase taxes or cut spending or both, and that could have some dampening impacts as far as the economy is concerned. Lynn's right. Eventually, though, we do have to address that. The balance. The question is when. You know, when are we going to do that? You know, my view is that with 9% unemployment at the national level, 10% at the local, 12% at the state level. Maybe there's a little bit more emphasis should be in dealing with the employment situation. But she's right. Once we get out of this, there has to be a clear path to deal with it in the future.
Okay.
if I can say, the big problem, though, another big problem, though, is everybody thinks it's great to deal with this as long as you don't touch what they like. And so basically the situation has gotten worse. They recently this week revised the deficit. It shows that deficit estimate were estimated to be over 1.5 trillion dollars, but largely due to the extension of the tax cuts. So again, I spoke at one event a little while ago, and I said, the only area of government that is growing is the federal government. And people say, yeah, that's terrible. And I said, well, it's largely due to Department of Defense type of activity, personnel. And I said, oh, okay, that's different. We think that's a great situation.
Yeah. So we think it's great to deal with it as long as they don't touch what we like. I
was going to say that wasn't supposed to be a transition.
I think the reality is, we know this. We get federal funding. Historically, our system has gotten more money when the economy is bad and less money when the economy is good, and that makes all the sense in the world. It's a system that's focused on needing to, focused on demand in those particular points in time. This is probably the first time we're going to see our system receive less money at a time when the demand is still through the roof, and we know that. I mean, the voices from Washington are indicating to our system everything from a 20% cut across just everything. Domestic spending, we know that at the state level, regardless of who the governor was going to be, and Governor Brown is the new governor, but even during the race, it was very clear that, there is such a huge problem at the state level that it has to be addressed. And there's such a climate in Washington for not wanting to spend any more. The President just gave a great State of the Union address. In my personal opinion, I don't know specifically how that translates into anything that he's going to do. It was a good moment. But I think ultimately when you start to get down to how much political will is there to continue to reinvest in places in the economy, and people view spending and investment as two very different terms, and in many instances are confusing them, I think. But if we don't invest in certain areas, then we're going to continue to see very slow job growth. If we invest in certain areas, we're maybe likely to see better short-term and long-term gains, but it could potentially mean more debt. So for us, what we're trying to do is, just like businesses that have learned to operate and do more with less during the recession, we've had to do that as a system for a long time. So as the Recovery Act money goes away, we know that we can't just cry and say that our programs and services are going to need to be smaller. Demand will still be high, so I think we then reach out as broad as we can to partners in the community to try to do what Dr. Reich urged us to do at our Workforce Summit, was don't rely on the government to create the solution. If you want to create a new initiative here in San Diego, rely on all these great partners that people have talked about at the table, bring them together around addressing some of these solutions and issues, and that's what we hope to do.
Mm-hmm. Connect has about a $3 million budget, and except for the grant that the county gives us for the innovation report, we do not receive any other government funding. So we last year began to work on an initiative with 33 other partners in the community, which led to San Diego being designated an innovation hub by the governor. He created an office called GoEd, which is around economic development. And we thought, and there was no money attached to us being an innovation hub. The designation is supposed to help us attract funding from the federal government. And we thought that Governor Brown would get rid of the GoEd office, but he's decided to keep it. And the state is looking at large corporate partners, big corporations that are going to come in as business partners and fund economic development initiatives in the state to promote the state as an innovation economy and also to help spur innovation. And the companies out of this effort will gain marketing, business deals, sales, branding. So I'm in the middle of working on a large proposal for one of these corporate partners right now, and if they can really pull this off, it could bring in some new sources of funding that could help our local economy.
Our efforts at the San Diego Association of Realtors specifically, I'll tell you where our focus is going to be this next year with our new incoming president, Bob Cavan. we know that the state will be taking a lot of the redevelopment money, as I mentioned. That's a huge issue, and it's something that they don't talk about too often publicly. And you'll see other cities right now kind of on a grab for money right now to kind of before they remove it. And hopefully that money gets spent properly. But that being said, the city councilmen that we've met with, you know, they need help. They need solutions. They don't know what to do, to be honest with you. And so other than cutting back services, spending less, and doing the obvious, is like Carl DeMaio mentions, he's got a pension plan, so on and so forth. As far as how it affects real estate, we're finding ourselves having to consider discussions. How do we accelerate the ability to build more units, whether it be rental or purchase? And so we find a lot of crossover between the BIA, which is the building industry, as well as the Apartment Owners Association. So for us, we're looking at how do you make those processes easier, less expensive, less cumbersome for the developer, and in exchange, the developer is building the right kind of units that we want to see going forward. So that's kind of where our head's at. As far as the bigger picture, we're more concerned with some of the tax. Obviously, we fought the parcel tax. I mean, who wants to tax the city of San Diego with a parcel tax? Wrong idea at the wrong time. You know, many of our communities, especially the newer communities, if you didn't know this, the city of San Diego tax base is 1%, but as you go into some of the newer communities, they have supplemental taxes, and you could be as high as 1.5 or 1.6 or 1.7%. So taxing parcels isn't always going to be the solution either. We're trying to help them find additional remedies, but going forward, the mortgage interest tax deduction, we have to take a defensive position there. And if you're influential, if you're involved politically, you know, tell your federal legislators that that's a bad idea. Yeah, I don't care what side of the fence you're on. I mean, it's really a bad thing for our economy. It'll hurt us.
Okay. I've got time for maybe half a question more. I think one of the other common denominators is there are many of the School of Business Administration students here today. And I think I want to ask just Mark Cafferty and Camille sort of about this, that we've heard a lot about go be a software engineer, go be an electrical engineer. There seems to be lots of demand for this kind of stuff. That's a great thing. So let's say you're a business student, but that's kind of the particular space you're interested in getting in. Is there some specific sort of business skill set or knowledge of the more technical science kind of oriented part of that industry that you'd advise some of our students if you want to try to break into that space? What do you need to know as a business student that you might not know?
One of the very best ways to gain the skills you need is through real-world experience. Back to Mark's discussion about summer jobs and internships and volunteering. Even if you need to volunteer to do it, joining a company and actually helping in different capacities is incredible. We have programs with USD and all the universities in San Diego, and we have a large mentoring program. About 200 companies go through it a year, and the students have the opportunity to work with the companies, and they tell me that they learn more in the couple of weeks that they're with us or the summer they're with us than they've learned in their entire time in college. So I talked about everybody working together and volunteering. It's a tremendous way to get experience on the resume, to get real-world experience and learn to solve problems, business problems, and then it's a wonderful thing to do for our community because it helps companies grow and create jobs faster.
And I would just add, I mean, from everything that Camille presented and the various economists presented, I think the most important thing to think about is how many of the businesses in San Diego are small businesses started by somebody. I mean, the reality is we can talk about these 3 or 4 large industries, and there are 3 or 4 large names in all those industries, and they all started somewhere. So I think the interesting thing about being a business school student right now is it's a tough economy. There's no doubt about it. But the skills that you all are learning, and by applying them through volunteering, I would add to Camille's list, there are some amazing industry associations in San Diego that bring industry together around a whole host of activities, presentations that they make to each other, particular initiatives that they want to focus on, political action. Get out and be visible there. Those places are pretty remarkable, and not every region has as rich and robust an industry association community as San Diego does, but your skills are going to be needed to run hospitals, to run nonprofit organizations, to be the leadership in school systems that are really not performing right now the way that they need to be, and that are going to be struggling in the years ahead and looking for good leadership, not just in the classroom, but also in the administration. We need minds like that in county and city government. So, the finance industry and some of those areas that have long employed MBAs will be there in the long run, but I think in the short run there's going to be no shortage of leadership and management opportunities for good, sharp people.
Can I make one more quickie?
Sure.
Many of the colleges partner in an entrepreneurship challenge, and when Mark was speaking, it reminded me of that. The business schools partner with the researchers and scientists, the PhD students, and they create actual businesses, whether just for the challenge or for the real world. And there are entrepreneurs in residence from the community that coach, and many businesses have actually been launched through these programs. And I recently read an article in the New York Times that a lot of business students are actually creating businesses, particularly software or e-commerce type businesses, social marketing businesses, and launching them as a way of getting into the job market. So, last two thoughts.
Okay.
Ryan is going to let me say.
Alan gets the last word.
Back in the late 1980s, when it looked like Japan was going to take over the world, one of their ministers, finance ministers, said about the U.S. economy. The problem with the U.S. economy is that they produce too many lawyers, MBAs, and flunkies. With all due respect to those of you who are lawyers, MBAs, or flunkies, he's probably correct. He was probably correct at that time, and that may be the situation here. I think the compensation situation got out of hand, and we had too many people going into those areas, not enough into the sciences and technologies. Maybe there will be a reversal of that. Sorry, though, to those of you in the School of Business at this point.
Okay, no, I get it. I'm sorry. We're at our time here. Okay, well, on that happy plug for the School of Business, I think we'll have to draw our day to a close. I think in brief summary of what I've heard today, we're definitely coming out of the darkest days. Things look better than they did last year. Still a variety of both fiscal and kind of job and skill match and housing mix match changes that we have to solve in the medium term. But at the same time, I think San Diego has all the things going for it that it always has. Great climate, great people, lots of entrepreneurial spirit, and a solid core of research institutions churning out those new ideas. I hope very much that you found the 27th Annual Economic Roundtable a useful and informative undertaking, and we'll be here next year for the 28th, and we'd love to see you back. So thank you very much for coming.